A very good morning, friends. So I hope you're all doing well. And most importantly, I hope you've done your cumulative revision on Ind AS 115. So we have covered quite a bit aspect in terms of Ind AS 115. And just to recall that out of the 5-step model, we have covered in detail the 3 steps with you so far. The step number 1 pertaining to identification of a contract, wherein you evaluate whether it's a valid contract or not, and where you got to focus in terms of the 5 conditions. Then we went to the step number 2, and that was identifying the performance obligations, and wherein the concept is with regard to the 2 conditions which are given in the para number 27. You start looking at things from the entity's perspective, and you start looking at things from the point of view of the customer, and then you identify whether a given promise is distinct or not, and if it is distinct, it becomes a performance obligation as well. Then we went to the step number 3, and that was determination of a transaction price, wherein we saw a total of 5 issues pertaining to the computation of a transaction price. The consideration being fixed, which we just need to be cautious that we don't consider any GST as a part of the fixed consideration. Then we discussed the concept of a variable consideration, where we made a 5-step model whether we consider the variable consideration as a part of the TP or not. Then we discussed the concept of a significant financing component, and wherein I gave you a 3-step model in terms of whether we segregate the element which is the finance interest or the finance charge as a part of the transaction price. Then the 4th aspect was in terms of a non-cash consideration, wherein basically we need to consider the fair value of the consideration received. The 5th aspect was in terms of consideration payable to the customer. If as an entity you pay a consideration to the customer, do you get something back in return? Is there any control of distinct goods and services you receive or not? And accordingly, the treatment follows. Now, having done the 3 steps with you, now the focus today is going to be on step number 4 as well as step number 5. Well, I would not say that step number 4 is not complicated or it's very easy. But yes, one of the aspects of step number 4 is slightly more interesting, I would say. Interesting, of course, means that there will be some technicalities attached to the interesting concept as well. Now, in step number 4, when we are discussing the allocation of a transaction price to the various performance obligation, apparently it seems it is just a blend of the step number 2 and the step number 3. Now, before I start with the step number 4 in detail with you, let me first of all give you a chain of thought on the basis of which we discuss the step number 4. So let's start with, first of all, the basic chain of thought. What you need to keep in mind as we discuss the step number 4 with you. So we are on the main step number 4 of Ind AS 115, and that is allocation. That is allocation of transaction price, I'm putting it as TP, to various performance obligations. Now, we've already seen the calculation of the transaction price in terms of step number 3. So as far as the transaction price is concerned, this we've already computed in step number 3. And as far as the performance obligation is concerned, this we've already identified in terms of step number 2. So basically what we're doing in terms of step number 4 is the allocation of what you determined in step 3 to the various obligations what you identified in step number 2. So this is what we're doing in terms of step number 4. Now, what are the critical points which we could confront in terms of step number 4? Number 1, I think it is logical to assume that if an entity is selling a bundle of goods and services, naturally there would be a discount. So for example, if an entity sells A plus B plus C, 3 goods, A plus B plus C together, it is quite possible that the sum total of the standalone selling prices, if you would have sold A, B, C separately, maybe you would have charged the customer, let's say for example, If I would have sold A, B, C separately, I would have charged, let's say, 1 lakh for A, and let's say 60,000 for B, and let's say 40,000 for C. So the sum total of the standalone prices would have been 2 lakh. But since the customer approaches you and buys a bundle of goods and services, there is a possibility that as a bundle, when you're selling the goods not individually but selling them as a bundle, you might have sold them, let's say, at 1.8 lakhs. Which means what? That there is a presence of a discount. So which means one thing is going to be very common, that when an entity is going to sell a bundle of goods and services to the customer, there is definitely going to be a discount. So this 20,000, which is a discount, now the question what comes to the mind is this discount relating to all the three products? Or is this discount relating to any particular product? Mind the concept very carefully. So I would say at the first instance, when you go to the step number 4, the first thing you should do is identify, is there a presence of a discount or not? So the first thing what you're going to do, you can add up the sum total of the standalone prices. Just identify in the question that if A or B or C would have been sold individually, what would have been the sum total of the standalone price? If the transaction price is less than, the sum total of the standalone selling price, this indicates that there is a presence of a discount. And the moment you see that there is a discount, you need to now identify, is this discount supposed to be on all three products, or is this going to be on any particular product, or maybe a combination of products, but not all? I hope you understand the language clearly. So we need to identify that, is this discount relating to all three? Is it relating to, let's say, A and B? Is it relating, let's say, to A and C, or maybe to a single product, but doesn't relate to all of them? Here, you don't need to remember the para, but I'm just giving you for your reference. Here, what you need to do in this particular case, the guidance is given in terms of para number 82. Para number 82 talks about that how do you consider that the discount on the bundle is related to a particular product, or is it relating to all the products in the bundle? That's one issue of discussion, which is not very typical. It's pretty easy, because once we go through the para number 82, you'll understand what kind of treatment to be done. That's one. Second, so this is one issue that is pertaining to discount. The other issue is what we did in terms of step number 3, that when you calculate the transaction price, there could be a presence of a variable consideration. Now, if there is a presence of a variable consideration, the question again comes to the mind that, is this variable consideration relating to all three products ABC? Let's take the same example. So let's consider that if the transaction price determined in this case, let's say, is 2 lakh rupees itself, but out of this 2 lakh rupees, we're saying that the fixed consideration is, let's say, 1.2 lakhs. And let's say the variable consideration is, let's say, to the extent of 0.8 lakhs. The question now arises that, do we consider that both the fixed and the variable consideration is relating to all the three products, or is this variable consideration relating to any specific product? It is quite possible that the agreement also makes a very specific mention. It is possible that the agreement makes a very specific mention that the amount of the variable consideration depends upon when the entity meets a particular performance obligation. So it might be written very clearly in the part of the agreement that the entity says, okay, once I deliver the product B, then I get entitled to the variable consideration, but we need to be cautious. I cannot accept the agreement which is stated directly. I cannot accept the language of the agreement. I need to look at the larger substance of the contract. So which means you need to be careful at this stage, even if the agreement, even if the question makes a very clear-cut mention that this variable consideration is relating to a particular product in the bundle, that doesn't mean that I would accept that. I need to evaluate that is this variable consideration related to a particular product in the bundle, or is it relating to all the products in the bundle, or maybe any one or two, but not all. So here, the standard gives us a guidance, and you do not need to remember the para number, but there is a guidance which is given in terms of para number 85, which talks about the allocation of the variable consideration. So basically, when you're going to confront the step number 4, there will be two agendas of discussion which is given in the standard. One is that an entity is selling the bundle in entirety. So naturally, there will be definitely some discount, because when you sell products on an individual basis, on a standalone basis, you will end up charging a more price. But when you give the customer a bundle, there is definitely an inbuilt discount. So we need to identify, is this discount relating to any one or all the products? And that's where para number 82 comes into account. And similarly, if the transaction price is comprising of a variable consideration, we need to be careful that even though the agreement makes a mention that this variable consideration relates to the satisfaction of a particular performance obligation, I'm not going to accept it on the face of it. I'm not going to accept the agreement on the face of it, but I'm going to use the data, use the concept which is given in para 85 to evaluate whether this variable consideration is related to any particular performance obligations, or is it relating to all the performance obligation. I hope, friends, my chain of thought in terms of the introduction to step 4 is pretty much clear. Okay, very good morning, friends, once again. So I hope my chain of thought is pretty much clear in terms of how you are going to go about the step number 4. So that was just an introduction. So now what I'm going to do, I'm going to do my discussion in two phases. First, I'm going to concentrate on discount. We'll understand the concept. Then I'm going to take you to a practical illustration on this. And there is one examination question, a quite recent examination question, which I'm going to do on that. Then I'm going to go to the variable consideration, and there is a wonderful illustration which is given in the study material with regard to the variable consideration. And then the step number 4 gets over, and then we come to the step number 5. Wow. So I think, let me first of all do one thing. I am just going to share a little inputs in terms of the para number 82. I'm just taking an extract of the para number 82. And I'm just going to read the para number 82 first of all with you. So I'm just going to give you the insight of what is stated in para number 82. I hope that is visibly quite clear, I guess. Yes, I think it's visibly clear. To me, I think it sounds that yes, it's quite visibly clear. Now, there is something more which I need to tell you as far as the allocation is concerned. But first, let's have a look at the para number 82, and then we'll proceed further. The language is going to be a slightly more typical, but we'll take an example to illustrate this part to you. Now, we are given the inputs out here. Entity shall allocate a discount entirely to one or more, but not all. The para number 82 is making a focus. Look at the language very carefully. The discount is going to be allocated to one or more, but not all. Let's take an example. Let's say the company is selling a bundle of products A plus B plus C. So the company is selling a bundle of goods A plus B plus C, and it says entity will allocate the discount entirely to one or more, but not all. So you may allocate it to A or B or C, or A plus B, or A plus C or B plus C, but not all. So para number 82 is telling you that the discount is not supposed to be divided among all the three. The discount is going to be divided between any one or any two, but not all the three. And when does this happen? It says if all the following conditions are met. So if you meet three conditions, now this is very crucial, because in the examination, you need to be very careful, and your mind should remember that how many parameters, how many conditions are there when you conclude that, okay, this is not going to be allocated to all of them. So it says the entity regularly sells, the word is very clear, regularly sells each distinct goods or service in the contract on a standalone basis. I need to put across a question to myself. Am I selling A, B, and C regularly, separately? The word is very clear. Am I selling A, B, C regularly, separately? Because it says regularly sells each good on a standalone basis. So I'll put across a question to the entity. Do you sell A or B or C regularly, separately, or a standalone basis? If they say a yes, the condition number one is met. Then there is a condition number two. The entity also regularly sells. The word is also regularly sells on a standalone basis a bundle of some of the distinct goods or services at a discount to the standalone prices of the goods. I'll say that do you sell any other bundle as well? You're selling ABC. Do you sell a bundle like EB? Do you sell a bundle like AC or a BC? So are you also regularly selling on a standalone basis a bundle which is comprising of some of these goods? So I am basically considering that are you selling goods which is a bundle which is a subset of this bundle ABC. So I'll put across a question, is the entity also selling another bundle like E plus B, or maybe A plus C, or maybe B plus C? So are you also regularly selling another bundle as well? And this bundle is a composition of some of the goods and services within the main bundle. So let's call this as a main bundle. And I would say that are you also regularly selling another bundle which is not comprising of all the goods and services in the main bundle, but it comprises of some of the goods and services in the main bundle? Next, the condition number three. Then he says the discount attributable to each bundle. So when I say the discount attributable to each bundle, so the company might be giving a discount on A plus B plus C. The company may be giving a discount on A plus B, B plus C, whatever the case might be. So we need to see what is the discount on the main bundle. We need to see what is the discount on the sub bundle. So the discount attributable to each bundle of goods and services described in 82B is substantially the same as the discount in the contract, which means the discount on the main bundle is substantially equal to the discount on the sub bundle. I'm using the words very carefully to make it very clear. The condition number three, that is the clause number C, is very clearly saying that the discount which is there on the bundle, that is the sub bundle which you identified in clause B, is substantially the same as the discount in the contract. So let's say, for example, when I looked at the main bundle, I identified that there is a discount of 20,000 on the main bundle. The company is also selling A plus B, and they are giving a discount of 20,000 on A plus B as well. What does that mean? If you sell A plus B plus C and you give a discount of 20, even if you sell A plus B and you give a discount of 20, let me ask you, does this mean that even by adding C, you don't give a discount? Does this mean that the discount is not allocable to C? Or indirectly, does this mean that the discount is allocable to A plus B? I put it again. So if you realize in your analysis that the discount given on A plus B plus C is 20, the discount given on A plus B is also 20, what does this indicate? That even if the company adds a product C to the bundle, they don't give more discount. So that means a company is adding another product line in the bundle, but they don't want to give you any extra discount. Does this mean that they're not willing to give a discount on C? So the discount of 20,000 basically relates to A plus B. There is no discount which is allocable to C. So when you are going to allocate the transaction price to the various goods and services in the bundle, I'll say, okay, the discount is allocable only to A and B and not to C. Now you must be thinking, so how would I allocate the discount? Don't get worried on that. that we'll understand in a practical illustration, but we've identified in the given example that this discount is not going to be allocable to the C in my example, right? Okay, so this is one inputs in this particular case. Now let's take it further. So I think I've understood the three conditions. Let me just quickly recap on the three conditions. So how are you going to proceed now in terms of step number 4? Typically, when there is a case of a discount, I'll make the life simple. Let me just first of all throw some insights out here. Now, I'm going to give you some notes as well, and I'm just going to add a few things as well, which I've not discussed so far, but I'm just going to add a few things in my note, and I'll explain along with that. So what we are looking at now in terms of the step number 4. In terms of the step number 4, I am looking at a special issue number 1. I'm looking at the special issue number 1, and the special issue number 1 is pertaining to discount. So while allocating the transaction price to the various performance obligations, I am first of all looking at the inputs in terms of the special issue 1, that is discount. So what I'm going to do first of all, so I am first of all going to take the sum total. I'm going to take the sum total of the stand-alone selling prices. I'm going to first of all take a sum total of the stand-alone selling prices of all goods and services in the bundle. So I'll say, okay, whatever is the bundle, let me take the sum total of the stand-alone prices of all the goods and services in the bundle and compare this with the transaction price, which you've computed in step number 3. So this is the very first exercise which you need to do, add up the sum total of the prices and compare it with the transaction price. Now, I would say there are two possibilities which would arise. One is that the stand-alone prices is exactly equal to transaction price, which is going to be a very rare circumstance. Because why would a customer get incentivized if you're not going to give him a discount? So this is a rare circumstance. Now, the other possibility is that the stand-alone selling prices is greater as compared to the transaction price. Now, you would say, sir, is it possible that the sum total of the stand-alone prices is less than the transaction price? Well, I don't think so. That is really possible. Because if a customer buys things individually and he has to pay 1 lakh, you can't charge him more than 1 lakh rupees, if you're going to sell him at his bundle. So logically, I see only two possibilities, that either the sum total of the stand-alone price is greater. If the sum total of the stand price is greater, this implies that there is a discount. And if it is equal, this implies that there is no discount. So the first thing you would do in the question is look at the sum total and compare it with the TP and identify is there a discount or not. Now, once you see that yes, there is a discount, then okay, we will allocate the transaction price to various goods and services. We will allocate the transaction price to various goods and services in the ratio of stand-alone selling prices. So once you realize that there is no discount, and let me also tell you that even if there is a discount, but I am not given information on para 82, I'll do the same thing. Let's say, for example, there is a discount, but the question doesn't give me any information on the para number 82. I'll follow this. I'll allocate the transaction price in the ratio of stand-alone price. Now, something which you need to know from a question perspective. Now, when I say stand-alone selling prices, the standard gives me some data. And you're going to see that language in the question as well. So I'll give you only inputs to the extent it is necessary from the examination perspective. So when you say that you need to consider a stand-alone selling prices, the standard says that it should be based on observable. It should be based on observable data. Now, what does observable data mean? That since you're selling the products regularly, you know the value at which they're sold in the market. So your stand-alone prices needs to be taken on an observable data. But the standard says, in case the observable data is not available, It says in case the observable data is not available, they say you still calculate a standalone price. They say that even if you cannot calculate the standalone price based on observable data, maybe you're not selling that particular product line on a separate basis, and you say, I don't have any observable market data. They say, don't worry, you still calculate an observable price. And how do you calculate that? There are certain methods which are available, and with the standard has given us a guidance, and there are three methods which are available. So they say that if you cannot determine a standalone price of a particular product, no worry, we are giving you certain methods with the help of which you go to determine a standalone price. And the methods which are given is, number one, we call it as adjusted. We call it as adjusted market assessment approach. We call it as adjusted market assessment approach. I'll explain what it is. So they say we need to use a technique which is called an adjusted market assessment approach. Then there is another method which is called expected cost. It is called expected cost plus margin approach. It is called expected cost plus a margin approach. And then there is another method which they call it as a residual method. It is called a residual method. Let me just explain this once again to you. I know this must have been a slightly little technical area, but let me just explain this. You know, by simply saying that you're going to allocate the transaction price in the ratio of the standalone price, the next question comes, where do we get the standalone price? I would say the standalone price is always available based on an observable data. A company is selling a bundle A plus B plus C. I tell them, okay, can you tell me what is the price at which you sell A or B or C individually in the market? The entity says, yes, we have the data. I can tell you at what price do we sell A or B or C separately. Then I'm going to put across another question. Let's say a second situation. They say, yes, we sell A and B separately, but we don't sell C separately. So we don't have any observable data with the help of which we can tell you that what is the standalone price of C. The standard Ind AS 115 says, boss, even if you don't have any observable data to calculate the price of C, don't worry. We are going to give you certain methods with the help of which you can determine the standalone prices of C. And the methods are adjusted market assessment approach, expected cost plus a margin approach, and a residual method. So could you explain what is this adjusted market assessment or expected cost plus margin plus a residual approach? Let me give you a basic insight now on this. Let's say, for example, a company, in the same example, the company is selling A, B, C. I sell A and B individually, but I don't sell C. But my competitors might be selling C individually. So I have a data of a product, the pricing of C, which is available in the market based on the competitors' prices. But I will not pick up the price of the competitor directly. So what I need to do, I will pick up the market prices of the competitors, but I will make some kind of adjustments considering, what kind of margins I would have expected, what kind of cost I would have incurred. So in this particular case, we're not going to directly pick up the competitors' prices, but we're going to make some kind of adjustments to those prices. And that is why it is called adjusted market assessment approach. Pick up the prices. You may not be selling directly, so you don't have a directly observable data, but what we're going to do, we're going to pick up the competitive prices and make some adjustments. So that is called adjusted market assessment approach. The second method which the standard is given is called the expected cost plus a margin approach. So even if the company is not selling C directly, it can always, make a calculations and try to make an estimation of what is the expected cost. Something like you calculate a standard cost of a product that you imagine that, okay, if this is the product, then what is the expected cost and what the management would expect as a profit. So take an expected cost, add an expected margin, a profit margin, and you're going to get a standalone price based on unobservable data. And then finally, there is a concept which is called a residual approach. And the residual approach is going to be very simple. You know the price at which you are selling A plus B plus C as a bundle. You know the standalone price of A and B. So from ABC minus A and B, you get the balancing figure, that is the price of C, which is called a residual approach. We're going to see this in a practical illustration as well. Okay, now let me, I think, just club this. Before I give you the three conditions of para 82, let me just consolidate the entire picture once again to you. So in step number 1 and step number 4, as I said, the very first focus is discount. The very first focus is a discount. So what you need to do at the very first instance, you are going to add up the sum total of the standalone selling prices. So let's say, for example, if the company is selling A plus B plus C, I'll look at the question and see, okay, what is the standalone price of A, B, C? I'll add them up and compare it with the transaction price. In a most idealistic situation, which is never going to happen, there is a possibility that the sum total of the standalone price and the transaction price is equal, which indicates no discount. And if there is no discount, no para 82 to be applied. Simply divide the transaction price in the ratio of the standalone price, that's it. And if you find out that the sum total of the standalone price is greater, there is a presence of a discount. Now you need to see, is the question giving me a data to apply the para number 82? And if it gives me a data to apply para number 82, I will see, okay, let me identify, is this discount relating to all three, any two, any one? And then the allocation will take place. How the allocation will take place in this case, I'll explain with an example. I'm not giving you the allocation. We'll explain that allocation with an example. And the other thing which I gave you, that what is a standalone price? I'll put the company a question. Are you selling ABC separately in the market? They say yes. I said, okay, boss, you've got observable data. Tell me what is the standalone prices of ABC, because you are selling them separately in the market. You've got observable data with you. But if they are not selling any particular product in the bundle separately, I'll say, no worry, we are giving you certain techniques with the help of which you can calculate the standalone prices. And there are three methods: adjusted market assessment approach. So when I say adjusted market assessment approach, pick up the prices of the competitors, adjust them and consider them to be a standalone price. Or use an expected cost plus a profit margin, or use a residual approach. So you need to get the standalone price, either observable data, or you can say with the help of these methods which the standard is defined. Right now, let me give you some notes on the three conditions. Then we are ready to do the practical illustrations with you. So let me first of all give you the three conditions which I mentioned in terms of para number 82. So the three conditions which are given in the para number 82, which is going to tell me that the discount relates to any one or more, but not all. So para number 82 is telling me that the discount relates to any one or more, brackets I'm saying, but not all. So it relates to any one or more products or goods or services, but not all. So you need to meet all three conditions. So let's see what are the three conditions which you need to meet. I'm going to put these conditions in simple language to you. So we've got condition number 1 plus the condition number 2 plus the condition number 3. Selling each goods and service in the bundle separately. So are they selling each good and service in the bundle separately? So you need to be selling each and every product separately. So that is one question. And then you go to the second question and you say, is the entity selling a combination? Is it selling a combination? So is it selling a combination of goods and services, which is, you can say, a sub bundle? So which is why I can say is a sub bundle. So are they selling any other combination as well? So are they selling a sub bundle as well? So which is comprising of, I'll just put a note out here, that is comprising of a few. So this is comprising of some goods or services. Underline the word some. So it is comprising of some goods and services out of the main bundle. Out of the main bundle. So we need to see that you're selling some other sub bundle as well. And this sub bundle is comprising of some of the goods and services out of the main bundle. So your answer should be a yes. The answer should be a yes, then only, and the third one, then only para 82 will get triggered. And the third one is that the discount on the main bundle, the discount on the main bundle is substantially equal. We are not saying that it is exactly equal, but we are saying that it is substantially equal. Let me make a box out here. So we are saying that the discount on the main bundle is substantially equal to the discount on the sub bundle. So the discount the company is offering on the main bundle and the discount on the sub bundle is supposed to be equal in nature. Right, first. So I guess you've taken a note on this. Let me see if there are any questions coming to your mind so far. I don't think so. Any questions so far? So let me ask you, are we pretty clear, friends, to the concept so far? Am I absolutely clear with the concept? Then I think we're ready to take you to some practical illustrations on this. So I hope I am pretty clear with the concept so far. Okay, so this is the inputs in terms of the special issue number 1, that is a discount. Let me now apply this to a practical illustration with you. So I'm just going to take you to a practical illustration. I've just inserted a few questions out here. Just give me a second. Okay, so I guess we can go on to the question on this area. So let me come to the assignment question number 25. And this is a question from the study material itself. So let's have a look at the question number 25 in the assignment. So I think that's pretty good enough, zoomed enough, I guess. We can visibly see it very well, I believe. Okay, absolutely clear, Nidhi. Great, clear, Koshki. That's wonderful indeed. Okay, let me, I think, start the journey. And let's look at the question number 25 now. It says an entity regularly sells the product X, Y, and Z individually. You know what is coming to my mind is one of the first conditions of para number 82, that the company is regularly selling separately X, Y, and Z. Great. Thereby establishing the following standalone selling prices. Now, let me remind you, in this particular case, the company is selling XYZ independently. That means there is an observable data, which means I don't need to apply any of the methods to determine a standalone price. So all these standalone prices are available from the observable data itself. It says, in addition, the entity is regularly selling product Y and Z together. Aha. This is giving me the condition number 2 of para number 82. The company is selling another bundle, which is including some of the products of the main bundle. The main bundle comprises XYZ, and the company is selling another bundle, which is 50,000. Now, let me see something. At this particular stage, let me see what is the price at which XYZ is sold. So let's take it further, and then I think we can make some more analysis. Now, we are given a couple of cases out here. So I am given a couple of cases out here. Let's, I think, go case by case out here. So we are given a total of 3 cases in this particular case. Let me see if we can zoom in a little more. Okay, I think that seems to be good enough. Okay, so now let's see a case. There are 3 cases which are given out here. Let's make a walkthrough. It says allocating a discount to one or more performance obligation. The entity enters into a contract with the customer to sell these products X, Y, and Z. It says for 1 lakh rupee. The entity will satisfy the performance obligations for each of the products at different points in time, and Y and Z at the same point in time. And then it says determine the allocation of the transaction price to product Y and Z. So let's concentrate on the first case. If I just come back on the data, we can see something very clearly now. I'm going to first of all do an exercise of identifying that is there a discount in the bundle or not. I know that the sum total of the standalone prices is 1,20,000, and I know the transaction price is to the extent of 1 lakh rupee. So there is distinctly a discount of 20,000. That is visibly clear that there is a discount of 20,000. So what comes to my mind is, okay, let me see now the concept of para 82. Is this discount related to all three? No. If you say that the discount is related to all three, which means para 82 fails. Mind the language carefully, which means that the para number 82 fails. So if you're saying that the discount relates to all three, what I will do, I will divide 1 lakh in the ratio of 50 is to 25 is to 45. That's it. So I'm going to see the para number 82. If the para number 82 conditions are not met, you are going to divide the transaction price of 1 lakh rupee in the ratio of the standalone price, and that's the end of it. But if para number 82 gets met, then we need to see how the allocation will be done. So let's look at the conditions which are given for the para number 82, and there are a total of 3 conditions. Let's evaluate the condition. Number 1, I'll put a question to myself. Is the company regularly and separately selling XYZ individually? He's very clearly telling me, yes, I am regularly and separately selling XYZ individually and separately. Condition 1 is met. Next, are you selling any other sub-bundle which comprises of certain goods and services within the main bundle? Yes, I am selling Y and Z. So the company is selling Y and Z, which is like a sub-bundle. We go to the condition number 3. Now let me ask myself, what is the discount I'm giving on XYZ? So what is the discount I give on XYZ, and what is the discount I give on Y and Z? I am giving a discount of 20,000 on XYZ because 120 is the sum total of the standalone price and 1 lakh is the GP. So the discount given on X plus Y plus Z is 20. And what is the discount you're giving on Y and Z? Y and Z is 25 plus 45. The standalone price is supposed to be 70,000. And you're selling them at 50,000, which means even the discount on Y and Z is 20. Oh, so the third condition is also met, which means that the company is not giving a discount on X, which means the company is not giving a discount on X. So the question now arises, how are you going to allocate the transaction price to the various performance obligation? I'll say there is no discount on X. So out of my TP of 1 lakh rupees, what I allocate to X is the standalone price 50 itself. I will first of all allocate my TP towards X, which is equal to the standalone price. And then I will allocate the remaining 50,000. The remaining 50,000 between Y and Z in the ratio of 25 is to 45, which is the standalone prices of Y and Z. This is how the allocation is going to take place if the discount is relating to any one or more, but not all the products in the line, right? I hope I'm pretty much clear of that. So 1 lakh is the transaction price. You first allocate the entire 50,000, which is the standalone price to X, and the remaining 50,000 is going to be allocated to Y and Z in the ratio of the standalone prices. That was the application of para number 82. I hope we are well understood with this. Okay, this was the case number A. Let me now take you to the case number B as well. Okay, I think, yes, Namrata, you've given the correct answer. Absolutely wonderful. Okay, now let's go to the case number B. Now, in terms of the case number B, you can see that there is a concept of a residual approach. So it seems that now they're going to take us to the case where the standalone prices on observable data cannot be computed. Then how does a residual approach apply? Let's have a look. It says the entity enters into a contract with the customer to sell the products X, Y, and Z as described in case A. The contract also includes a promise to transfer the product alpha. So now we've got four products in the kitty. One is X, Y, Z, and one is alpha. It says total consideration in the contract is 1,30,000. That becomes a TP. The standalone prices for product alpha is highly variable because the entity sells alpha to different customers for a broad range. They're selling the customers alpha in a range of 15:45. To some customers, they sell at 15. To some customers, they sell at as high as 45, which means on a simple average basis, they are selling alpha at 30. Because if you take a simple of 15 and 45, the simple average comes to 30, looking at the two extremes. Determine the standalone prices of X, Y, Z, and alpha using a residual approach. Now, this question is not exactly on the allocation part, but it's more on the computation of a standalone prices of alpha using a residual approach. Mind the words. The focus in case number B is calculating, you can say the standalone prices of a particular product using a residual approach. Very simple. Can I say we have got 1,30,000 as the total transaction price? We've already seen in the case number A that out of this 1,30,000, you are going to allocate 1,00,000 rupees to X plus Y plus Z, out of which individually you will break up. That you allocated 50,000 to X and the remaining 50 to Y and Z that we've already seen in case A. Which means what? The remaining 30,000 should be related to alpha. You're taking a balancing figure, a residual approach. So 1,30,000, out of which 1,00,000 gets allocated to X, Y, Z. So we say, okay, what is the residual left over? The balancing figure residual is 30. Now you cannot say that the journey ends at this stage. If you take a balancing figure out of TP allocated towards alpha, you also need to see that is this really an acceptable value or not? Now the entity knows that they've been selling the product alpha in the range of 15:45, so on an average 30. I think it seems to be quite a representative balancing figure. So in this particular case, once you take a balancing figure, you are getting a figure which is based on the data that on an average generally we sell at 30. So residual approach seems to be quite appropriate in this particular case. Considering that we've got a very good representative average, we can say, yes, the residual approach seems to be good. Now you must be thinking, sir, if this balancing figure doesn't match with the average, then what? Case number C. We're going to see in case number C. So in case B, they're explaining us that when a residual value approach is acceptable, and we're going to see another case where the residual approach is not acceptable. Let's have a look now on case C. The residual approach is inappropriate. The same facts in case B apply to case C, except now the transaction price is 1,05,000 and not 1,30,000. So he's changed the overall transaction price. So do the same thing. We know that the transaction price is 1,05,000, and we've already seen in case A that 1,00,000 is related to X plus Y plus Z. So which means the balancing figure 5,000 is supposed to be related to alpha using a residual approach. If I use a residual approach, I would say out of this, the balancing figure that is 5,000. Now, is this balancing figure 5,000 a representation of the average? No. The standard says a residual approach cannot be used. So then what do? We'll tell the company, boss, please devise any other method. Go in for an adjusted market assessment approach, or go in for, expected cost plus a margin approach. But this residual approach seems to be quite inappropriate, and you cannot consider that the amount to be allocated to alpha is 5,000. So we will say it is inappropriate in this particular case. I am not given any data in the question, with the help of which I can tell you that how would you calculate the standalone prices of alpha. But all what we need to mention to the examiner is that this approach of residual approach is inappropriate in this particular case. Some other method needs to be applied. Okay, I guess I am pretty much clear, friends, on the concept of allocation of discount. In fact, there has been a wonderful question, which came in the exams, and this question came in July 21. Would you like to make a guess? I've been spending a good time on this particular concept for the reason I look at the weightage of this particular concept in the exam. July 21, 12 marks in the exam. Can you see the interesting trail in terms of things? See, in November 2020, there was an examination question, 14 marks in the exam, that was on the concept of step number 3, and that was variable consideration. Then you can see in January 21, there was another 12 marks question in the exam that was again on step number 3, that was pertaining to significant financing component. Then you can see in July 21, there was another 12 marks question in the exam pertaining to step number 4, which is on the concept of a discount, which you have discussed. So I think you can do that particular question. I'm going to share the assignment to you. The answer is also clearly given in this case. It's quite similar to what we've done in the previous question. The previous question which we done is from the study material, and this is an examination question. I think you can easily manage. I've therefore given the solution as well. Okay, let me see if there is any questions come in the meantime. Otherwise, let's take it further. Okay, Namrata, you I think said, if the price comes to 15,000 instead of 30, also, is it appropriate or not? No, I think it should be quite close to the average of 30. And I think there is a variation in terms of the residual approach that it is not close to 30. I can understand 27, 28. If it comes, residual approach is appropriate, but I think too much of a variation would lead to inappropriate approach. Right. Okay, so this is done. Now I am going to take you to the next agenda. Friends, this is slightly going to be more technical as compared to a discussion, but watch this carefully. So I'm now going to take you to the next area of discussion, and that is the special issue number 2 related to variable consideration. There is a beautiful question which is given in the study mat, and I think I am very keenly interested in doing that question because wo nahi kiya to kya kiya. So I think that is one particular question I think which I definitely want to do, because I know that question is going to take a little time, but I think we have that time because I am on step number 4. After that variable consideration, step 4 gets over. Step 5 is not a very technical step either. Okay. So let's, I think, make a discussion with reference to the step number 4, and we're looking at now the special issue number 2. So I'm looking at the special issue number 2, and the special issue number 2 is with regard to the variable consideration. Now, in this particular connect, I think I need to first explain the chain of thought to you, and then we're going to take it further. Now, hear me carefully, because this is going to be slightly more technical as compared to the agenda of a discount. As I said, the guidance in terms of variable consideration is given in terms of para 85. You don't need to remember the para, but I'm just giving you for cross reference. One thing which you need to keep in mind, and this is where your people generally go wrong, and that is the agreement. And I'm telling you now something in generic as far as Ind AS is concerned. If somebody were to tell me that, can you tell us something very peculiar in Ind AS? I'm not talking of Ind AS 115, I'm talking of Ind AS in general. And somebody would ask me and tell me, so tell us something, which is very peculiar in terms of Ind AS or IFRS. I will say one of the most peculiar and the interesting things is that we will always ignore the agreement and we will start looking at the substance of the agreement. It's like, lifting of the corporate wheel. It's like looking at parde ke piche kya hai. So I am more interested in that I can't stop the people from making an agreement according to their whims and fancies. You cannot stop the two people entering into a contract. They're free to contract and they're free to decide the terms and conditions on the basis of which they enter into the agreement. But their terms and conditions of the agreement cannot be a basis of my accounting. So you are free to decide the way you want to draft an agreement, but my accounting is going to be based on not your agreement. My accounting is going to be based on the substance of the agreement. This is the essence of Ind AS. This is the essence of, you can say, IFRS, that we are not looking at what the agreement states. I'm not going to accept things on the face value and start accounting for the agreement on the basis of the face of the agreement. You're going to see this in many standards, like when you're going to do financial instruments as well, you're going to see that we're going to start looking at the larger substance of the transaction rather than the agreement. Now, why I'm overemphasizing this particular issue, typically in terms of the variable consideration, let's say, for example, the company is providing, let's say, two goods A and B, and the agreement makes a mention that the fixed consideration is related to A and the variable consideration is related to B. They make an agreement. And the agreement very clearly says that the fixed consideration is related to the performance obligation A and the variable consideration is related to the performance obligation B. Sorry, I don't accept. I'm going to evaluate. That maybe the substance of the transaction says, yes, it is correct. But maybe the substance of the transaction tells me, no, it is not correct. So paragraph 85 gives you the guidance of how to evaluate the substance of the transaction, looking into a little more deeper angle and identifying that what the agreement is stating is the substance of the transaction, or is this something which I don't accept for accounting. So let's have a look at the paragraph 85. I've just taken a little extract of the paragraph 85. Let's have a look, friends, out here on what the paragraph 85 tells me. So this is just an extract. It's given in the study material as well. But we're just going to have a look at the inputs, what is stated out here. Let me zoom it further more so we can see it very clear. Yes, this makes more good sense, I guess. Visibly quite clear indeed. Okay, and my request, friends, of course, is, once you're done, and Shriram, you said, sir, are we going to get the notes afterwards? Of course, yeah, I'm going to give you the notes as well. Just as I gave you the notes for discount, I'm going to give you the notes on the variable consideration as well. And all these will be shared on the portal of the ICI. Okay, now let's read what is stated in the para number 85. It says an entity shall allocate a variable amount, I'm leaving the brackets, entirely to a performance obligation or to a distinct goods or services that forms a part of a single performance obligation if both the conditions are met. So you're going to allocate the variable consideration entirely to a performance obligation. I'm going to allocate this entirely to a performance obligation. It says if the two conditions are met. What are the two conditions? The terms of the variable payment relate specifically to the entity's efforts to satisfy the performance obligation. In simple words, the clause A says, I'm going to look at the agreement. And after looking at the agreement, I will say, okay, what is the terms of the agreement? Is the terms of the agreement saying that the efforts of the entity is specifically related to, the variable consideration is specifically related to a given performance obligation? And then it says, allocating the variable amount of consideration entirely to the performance obligation is consistent with the allocation objective in para number 73. So this is too technical indeed. We did not understand what he's saying in clause A and clause B. Clause A, we still could understand that we need to look at the agreement, but what is he saying in clause B? That, it has to be consistent with the objective in terms of para number 73. Okay, let me explain this in simple words to you. I never read what is given in para number 73, but let me illustrate and explain what does para number 73 states. You need to consider one thing, that there is a basic principle behind step number 4. Now, mind the words carefully, what I'm explaining right now. Hear each and every word very carefully in terms of step number 4. There is a basic principle which underlines the step number 4, that in step number 4, when you say that you want to allocate the transaction price to the various performance obligations, there is one basic objective you need to keep in mind. Let's say if you're allocating the, let's say, transaction price to 3 performance obligations, you'll land up allocating, let's say, 2 lakhs to A, you'll land up allocating 3 lakhs to B, and you'll land up allocating, let's say, 5 lakhs to C. I need to be careful that whatever amount gets allocated to each and every performance obligation does not result in overstatement or understatement of revenue. I need to be very careful that if a company would have made a sale of A on a standalone basis, what revenue it would have recognized. Now, if you're selling things in a bundle, I'll tell you now what an entity can manipulate in an agreement so that you understand why the spirit of step number 4 is being created like this. Let me explain. Do you think an entity would try to manipulate the revenue recognition? If I know that my IPO is going to come in, or let's say my FPO is going to come in, I am planning, let me, trigger more revenue recognition at this stage. I could manipulate things. So what I could do, when I create an agreement with my customer, I intentionally create an agreement in such a way that I would say, let me allocate, more revenue towards A. I will say the fixed consideration relates to A because I know that performance obligation of A is going to be met before B and C. Hear this very carefully. I'm looking at the manipulative intent which entities can have. Because when the standard setters are creating a standard, they're looking at how the entities in a practical life, could manipulate the things, and they could consider manipulating the revenue recognition in the books of accounts. So as an entity, I know that out of these 3 performance obligations, A is the one which is going to be recognized, which is going to be finished earlier. I know that I would be able to meet the performance obligation A much earlier as compared to the performance obligation B and C. So as an entity, if I'm planning to manipulate my revenue recognition, what will I do? I will land up and saying that a larger portion of the TP relates to A. I'll put it in the agreement. I'll put it in the agreement that I am taking, let's say, 10 lakh rupees consideration from the customer. And I'll very clearly put it in the agreement that out of this 10 lakh, 8 lakh relates to A. So is there somebody who's going to question that? Of course, as auditors, as we have the concept of Ind AS 115, I'm going to challenge that very concept and tell the entity, boss, you are free to make any kind of agreement. You can tell the customer that out of 10 lakh rupees, once I perform A, you want to collect 8 lakhs out of him, you can do that. He's willing to pay you. You're wanting to charge him. Good. But that doesn't mean that the basis of accounting is going to be based on your whims and fancies. Are you getting the point? So the entities, while drafting the agreements, could do something that they would try to allocate a larger amount of TP towards those performance obligations which are going to get met earlier, so that they are able to accelerate the revenue recognition in the books of accounts. So I cannot accept the agreement. So if they say that, a certain amount of consideration relates to A, I'm not going to accept that. So the basic premise with which the step number 4 was created is being stated in para number 73. The para number 73 very clearly states that, once you allocate the transaction price to the various performance obligations, you need to be very clear on the idea that it should not lead to understatement or overstatement of revenue for any of these performance obligations. It should not happen that if I start putting a question that, okay, if I would have sold A separately, and I know that the revenue recognition would have been just 1 lakh rupees, then this allocation that you're allocating 2 lakh rupees seems to be illogical in nature. So you need to be ensured that once you allocate the transaction price, it should not result in understatement or overstatement of revenue for any of these performance obligation. And that's what the clause number B says, that allocating the variable consideration entirely to a performance obligation is consistent with para 73. So if the agreement says that the variable consideration relates to A, I'll say, okay, what you're saying, I accept, but let me apply my mind. So the clause number E is saying the terms are very clear. So what I'm going to do in terms of para number 85, I'll first read the agreement. I'll say, okay, the agreement says the variable consideration relates to A. Okay, accept it. Wait, I'll say, let me evaluate my mind as well. Once you land up allocating the variable consideration towards A, my mind is telling me, boss, this is not acceptable. Because if you would have recognized revenue separately for A, you would have landed up taking only 1 lakh allocation. You are allocating more. There is some problem. I don't accept. I think we need to take a practical illustration to explain this agenda to you. I'll come with the notes later, but let me just take a practical illustration, first of all, to illustrate this particular issue. So let's, I think, go to a practical illustration on a variable consideration with you. So this is the illustration which you have got on this area. Okay, so I think this is the wonderful illustration. Let me just come to this illustration. That is question number 27. This question number 27 is also there in the study material as well, I guess. But this is not that question which I was talking of. Oh no, this is, yes, this is one of the questions which is there. You know, the study material has done a very good analysis of this question. I'll just come to that, but let's first go to the very basics. Let's first of all go to the very basics of this illustration. Let's have a look. Let me try to zoom it a little further. Yes, I think now we can visibly see it much better, I guess. So let me now read the inputs to you. So we are now taking an example to understand the concept of the special issue, the variable consideration related to a transaction price. So let's have a read. It says an entity enters into a contract with a customer for 2 intellectual property licenses, that is A and B. So we can see that there are supposed to be a total of 2 performance obligations. There is a license A and there is a license B, which the entity determines to represent 2 performance obligations. So he's made my life simple, and he's very clearly given me the step number 2, that there are 2 performance obligations, each satisfied at a point in time. Though we yet to discuss step number 5, but I think I've just made a mention earlier as well that step number 5 is dealing with the recognition of revenue, the timing factor for the recognition of revenue. And we said earlier that there are 2 methods for recognition of revenue. One is called the POCM, the percentage of completion method, and one is the CCM, that is a completed contract method. So in this particular case, when I say that each is satisfied at a point in time, that means we are going to recognize revenue on the basis of a CCM, a completed contract method. The standalone selling prices of A and B is given. So 16 lakhs is the standalone price of A and 20 lakh is the standalone price of B. Which means one thing is coming to my mind, that if I am selling a bundle A plus B put together, one thing is very clear, that at the end of the day, the revenue recognition for A should be almost equal to 16 lakhs. The revenue recognition for B should almost be equal to 20 lakhs, considering that if there might be a discount or there may not be a discount. Because if the standalone prices of A is 16 and 20, which tells me in my mind that if A would have been sold separately, the company would have landed up recognizing a revenue of 16 lakh, and the company would have landed up recognizing a revenue of 20 lakhs in terms of B. So in any case, the allocation should not result in a situation where the revenue recognition of A and B is not approximately equal to 16 and 20 lakh. Otherwise, the violation of the para number 73 would take place. It says the entity transfers the license at the inception of the contract. So they've transferred the license B at the inception and the license A at 1 month later. Okay, now let's look at the case number A. It says variable consideration is allocated entirely to one performance obligation. Now I'm going to evaluate the concept of para 85. So watch my analysis very carefully. It says the price stated in the contract for license A is a fixed amount of 16 lakh. I'm looking at the clause number 1 of the para number 85 and the terms of the agreement. So what does the terms of the agreement says? The contract is explicitly making a mention that the fixed amount of 16 lakh relates to A. I guess if I look at this stage, if you would have sold A on a standalone basis, the prices would have been 16 lakhs. And in the bundle also, the contract states that the fixed consideration 16 relates to A. It seems that there is no manipulation. It seems that the terms of the agreement is not inconsistent with para 73. Are you getting the point? So there are two things you're looking at para number 85. You're first of all looking at the agreement. Let me accept what the agreement states. The agreement says that the fixed consideration relates to A. Okay, I go and see if I accept the agreement, would it lead to understatement or overstatement of revenue? No, because even if you would have taken a revenue on a standalone basis, you would have taken a revenue of 16 lakhs for A. So I think the agreement is not in conflict with the objectives of para number 73. It would not lead to overstatement or understatement of revenue. And for the license B, the consideration is 3% of the customer's future sales of the product. So that means that the consideration for B is a variable consideration because it is 3% of the future sales. For the purposes of allocation, the entity estimates that the sale-based royalties, they've calculated the value of the variable consideration and the value of the variable consideration is 20 lakhs. Allocate the transaction price. Now, let me now apply the two steps in terms of the para number 85. So what do? I go to the first one, I say, okay, what does the agreement state? Don't worry, I'll give you the notes very soon, but I'm going to put across a question number 1. I'll say, okay, what is the terms of the agreement? The terms of the agreement is that the fixed consideration is relating to license A and the variable consideration is relating to the license B. This is what I note down in step number 1, what the agreement states. Okay, let me go to the step number 2, the second condition. I'll say, let me evaluate. Should I accept the terms or not? It should not lead to any understatement, overstatement of revenue. So I say, okay, let me find out the standalone prices of A and B. I say the standalone prices of A is 16 lakhs and the standalone prices of B is 20 lakhs. That's what is clearly given, the standalone prices. I say, okay, now let me check the consistency. If the fixed consideration in the contract is given 16, this means that there will be no problem. The agreement states 16 lakh relates to A. My standalone prices say, yes, 16 lakh relates to A. Good. Then the variable consideration in this case is 20 lakhs. And I say, what is the standalone price of B20? So basically, you're going to compare the consideration which is written in the agreement is consistent with the standalone price. If the consideration given in the agreement, the breakup of the consideration given in the agreement is consistent with what is the standalone price, that means I'm willing to accept the agreement, which means that I'm saying that there is no manipulation. So I'm saying, yes, it will not lead to understatement. It will not lead to overstatement of revenue. So I think this is acceptable. So you will allocate fixed consideration to A and you will allocate 20 lakh variable considerations to B, because we don't see any inconsistency between the standalone prices and what is stated in the agreement, right? I hope I am pretty much clear on the agenda so far. Okay, let's, I think, take it further. Then let's look at the case number B. It says variable consideration allocated on the basis of standalone price. The price stated in the contract A is a fixed amount of 6 lakh. Now the agreement is making a statement that the fixed consideration relates to A, which is 6 lakh. And for the license B, the consideration is 5% of the future sales. And the entity estimates that the sales-based royalty, that is the amount of variable consideration, is 30 lakhs. Then he says license A is transferred in 3 months later. The royalty due from the customer in the first month sale is 4 lakh. Allocate the transaction price and determine the revenue to be taken. Now let's apply the para number 85 in this particular case. So I will first of all go to my condition number 1. Let me look at the terms of the agreement. Let me see what the agreement is stated in this particular case. I said, okay, what does the agreement state? It says that the fixed consideration relates to A, which is 6 lakh, and it says the variable consideration is relating to B, which is supposed to be 30 lakhs. So just write down, in terms of the condition number 1, just write down what the agreement states. The agreement states that the fixed consideration 6 lakh relates to A and the variable consideration 30 lakh relates to B. Okay, let's go to the second condition. Let me now see what is the standalone prices in this particular case. I said the standalone prices for A is 16 and the standalone price for B is 20 lakhs. If you accept the agreement, would it lead to understatement or overstatement of revenue? Of course. If you accept the agreement, it says that 6 lakh gets allocated to A, but the revenue recognition on a standalone basis should be 16. It'll lead to understatement of revenue for A. The company is manipulating. And even in this case, if you consider the agreement, then 30 lakh gets allocated to B, but the standalone prices is 20. It leads to inconsistency. It would lead to an overstatement of revenue recognition for B. The company is indirectly manipulating the agreement. They are trying to unnecessarily, write something in the agreement which is inconsistent with the revenue recognition principle. Because my revenue recognition should result in a revenue which would have been had you sold A and B on a standalone basis. So the allocation based on a step number 4 should not result in simple words, understatement of revenue or overstatement of revenue. So which means I will say, boss, I don't accept the agreement. I don't accept what you've written in the agreement that fixed consideration is related to A and variable is related to B. I'll say, I am now saying that this is 36 lakh, this is 36 lakh. Your breakup seems to be illogical to me. So I'm giving a conclusion that the fixed and the variable consideration relates both to A and B combined. You cannot say that the fixed consideration relates to A. You cannot say that the variable consideration relates to B. I'll say that you are manipulating the breakup of the consideration. So in this case, the fixed consideration is relating to A and B. The variable is relating to A and B. Did you get my analysis on this, friends? Because there is another aspect of this particular question. If you look at in the study material, they've done some more analysis and they've taken us to the step number 5 as well. And I'm also very keenly interested in taking the step number 5 in this particular question. So if you're well understood to this stage, let me know. Then I think I can take you a little further, get you a little feel in terms of step number 5. Because in this question, the question didn't stop at this end. It says determine the revenue to be recognized. It's not only asking you the step number 4 in terms of allocation of the transaction price, it is also asking you to give me what is the recognition of revenue, which is going to be very interesting indeed. But let me see if we are pretty much clear to this particular stage, then I think we take it further. Yes, clear. Okay, wonderful indeed. So I think we can add on something more. I'll share the study material, but first, I think let's give you some notes on the para number 85 special issue, then I think we'll get more deep into this particular question. So let me just come back and give you some notes on this area. So we were discussing the concept of the special issue number 2. So let's make some notes first of all on this area. Okay, so I think let's go to the special issue number 2, that is on the variable consideration. And I'll give you simple inputs how you are going to evaluate the para number 85. So let's see how we are going to look at the para number 85. I'll just put the notes in a very simple little language to you so that you can easily apply the same. So in terms of para 85, I can say you need to do step number 1 and you need to do a step number 2. So what I'm going to do in step number 1, I will document the terms of the agreement. In the step number 1, we're going to document the terms of the agreement. So we will say, okay, whatever the agreement states, let's note it down. So we will document the terms of the agreement and say, okay, the fixed consideration relates to what? We'll note down that the fixed consideration relates to which particular product. We'll say, okay, the variable consideration relates to which particular product. Just make a note. Just make a note in terms of step number 1 that, okay, this fixed consideration relates to this and this variable relates to this. Just note down the terms of the agreement. Then in terms of step number 2, make a note of the standalone selling prices. Make a note of the standalone selling prices, and then what you need to do is a comparison. So we're going to compare the step number 1 and the step number 2. We're going to compare the step number 1 versus the step number 2. So there are two possibilities. It is consistent. The standalone price and what is written in the agreement is consistent, or it is inconsistent. So it may be consistent, as we saw in the case number 1, that it was consistent. It was equal. What you wrote in step 1 and 2 was equal. It was consistent. So if it is consistent or if it is inconsistent. Now, if you say that it is consistent, then we accept the agreement. Then we accept the agreement as it is, and we say, okay, what the agreement states is true. We'll go with the agreements, and the accounting will be as per the agreement itself. That the fixed consideration relates to this product, the variable consideration relates to this product. But if it is inconsistent, then we will not accept the agreement. We challenge the agreement, and we will define the accounting according to the substance of the transaction. So this is the insight in terms of the special issue number 2. That you need to basically see the terms of the agreement, and you need to see the comparison of the standalone prices. If they're consistent, then you accept the agreement for accounting. But if it is inconsistent, you don't accept the agreement, and you're going to challenge what the agreement states. You say you made an agreement, but sorry, my accounting is not based on what you said in the agreement. Okay. So I guess you've taken a note on this. Now let me do one thing. Let me just add the study material to you, and we will go a little more deeper. So I'm going to go a little more deeper in this particular illustration to you, because this is going to give us a little feel in terms of the step number 5 as well. So I'm interested in taking you to the study material as well, because this is one of the very good illustrations in the study mat, and they give a very good insight on the step number 5. Because we're done with step 4 now. Let me tell you, we're done with step 4. So we are now entering the step number 5. So before we enter the step number 5, let's, I think, give you a feel with this illustration on the concept step 5. So what I'm about to discuss, friends, in the next 15-20 minutes is going to be slightly more technical as compared to the earlier discussion in the morning. So don't get worried, but this is going to be technical. So I might have to repeat it again. So, but don't get worried on this. So it's going to be slightly more technical. So don't get worried. I guess let me just locate this illustration in the study mat first. This is a part of the step number 4, so I think we'll have to take a little more jump. Okay, so we're quite close. This is on the step number 3, and yes, this is almost the end of the step number 3. And yes, this is on the step number 4. We've reached the step number 4. Yes, this is it. Wow, we reached the answer. Now, please watch this very carefully, friends. So this is page number 3.83 of the study material, the same example which I was doing with you. So this is illustration number 56, page number 3.83 in the study mat. Same example. I'm now going to take this illustration walkthrough with you and give you some more good insights on this. Let's see if we can zoom in a little further as well. Yes, great. Now, watch this carefully. The analysis, what we are about to discuss, is slightly more technical, but please give a very patient and a very concentrated listening to me. Okay, let's begin the journey. I'm going to reread the question again because I want to now add something more flavor. So we are done with the step number 4 part. We are making now a background on step 5. So before we create a background on step 5, we are doing this illustration again with you. Let's wait. An entity enters into a contract with a customer for 2 intellectual property licenses, A and B, which the entity determines that they are 2 performance obligations, each satisfied at a point in time. When I say a point in time, it means completed contract method as per the step number 5. He says the obligations are going to met at a point in time. It is either said that it is met over time. So when I use the word over time, it means a percentage of completion method. When I say at a point in time, it means a completed contract method. The standalone prices of A and B is 16 and 20 lakh respectively. The entity transfers license B at the inception. It transfers license B at the inception and transfers license A 1 month later. Now, one caution, friends, at this stage on the step number 5. In case number A, hear this very carefully. In case number A, we said that the agreement is not inconsistent with the allocation. Whatever allocation is going to take place based on the agreement is correct, which means what? As for the case number A, we decided that the fixed consideration relates to A and the variable consideration relates to B. So we accepted that yes, the agreement is correct. Now, let me just add something further. Let me just, I think, give you some more insights at this particular stage. Let's have a look out here. So we're looking at the case number A. We're looking at the case number A, where you said that the agreement is perfectly okay. The fixed consideration of 16 lakh relates to A, well accepted, and the variable consideration is relating to B, that is worth 20 lakhs. Now, what is stated in this particular question is that the timing factor for the recognition of revenue, the timing factor for the revenue recognition is what? It states in the question that license A, if you go back to the question, it says that the license A will be transferred a month later, and the license B is going to be transferred at the inception. So it says the revenue in this case is 1 month later because you are going to transfer the control. You're going to transfer the control 1 month later, and in this case, the control is transferred at the very inception. But now, if somebody were to ask at this particular stage that in this particular case, the control is transferred right now, but the consideration is variable in nature, there is a guidance which is given in the appendix P of Ind AS 115. And you know what the guidance states? The guidance in the appendix P states that if your consideration is based on sales-based royalty, the clarification which is given is that if your consideration is variable and it is based on a sales-based royalty, which in this case is true, they say the revenue recognition is going to take place at the later of the 2 dates. Number 1, when the sales will take place, and number 2, when the control of the goods is transferred to the customer, whichever is later. The standard says in the appendix that if your consideration is based on a variable consideration, which is a sales-based royalty, you cannot recognize the revenue at the inception. You can recognize the revenue at the later of the 2 dates when the sales will take place or when the control is transferred, whichever is later. So which means effectively considering this guidance, I will be able to recognize revenue only once the sale is made. I hope you got the point. So which means now that as far as A is concerned, you will be able to recognize a revenue 1 month later. So let's say if you receive an advance from the customer, let's say there are two possibilities that the fixed consideration is collected as an advance. So if you've collected this money as an advance, for example, then what should I do? I will put the entry bank account debit and I'll give a contract liability or a deferred revenue as a credit. Because at this particular stage, if you receive an advance, you cannot recognize a revenue. So you're going to park this money, you're going to park this advance money as a contract liability or a deferred revenue as of now. And then you can say, once that 1 month passes by, you can put the entry contract liability gets a debit and the revenue is going to get a credit at that particular stage. So I'm just looking at the fixed consideration that in this case, if you receive an advance, you park that advance in the contract liability or a deferred income account because the obligation is not yet met. The company cannot recognize revenue at this particular stage, and then you are going to put this money, convert that contract liability into a revenue 1 month later. Or let's say if there is no advance, let's say if there is no advance at this particular stage, no worry. So what you will do 1 month later, once you receive the money, you can either say bank account debit or trade receivable gets a debit, and you can recognize the revenue at that particular stage. I'm not considering any financing component elements out there. So in this particular case, you need to be careful that what kind of accounting entries are going to be passed. So if it is a case where you receive an advance, park it in the liability, convert that liability into revenue at a later date. And if you're not receiving any advance, then only after 1 month, the revenue recognition will take place. You get the money, bank debit, or if you don't get the money, create a trade receivable, account receivable, and give a credit to the revenue. Now let's come to the license number B. In terms of the license number B, since we are saying the revenue recognition is going to take place only when the sales arises, there cannot be a case of advance because you are going to get the money only once the sale is made. So what I'm going to do, it's only when the sales are made, then you are going to put the entry bank account debit once you receive the money, or account receivable gets a debit, and the revenue is going to be given a credit at this stage. In spite of the fact that the control of the license is being given to the customer at the very inception, you'll have to wait for passing a journal entry only once the sale is made. You cannot do any entries at the time of inception when the control of the license is given to the customer. I hope, friends, I am pretty much clear on my analysis so far. Okay, Kashki, control on inception, how to determine when the sale takes place. Welcome back, friends. Sorry, there was a little lexity cut, and due to which we had to take a little premature break with you. But don't worry, I think everything is fine now. So I'm just going to take back to the trail of discussion what I was doing a couple of minutes back with you. So in this particular case, I was making a mention in this illustration number 56 of the study mat, where I said that we're looking at a bit application in terms of step number 5. And I was concentrating on one particular aspect that was on case number A in that particular case. That if we say that yes, the terms of the agreement are not inconsistent with the allocation principle, and we accept that yes, what the agreement states is perfectly correct, then in that particular case, we were given the insights number 1 that in this particular case, we are saying, okay, I think I'll have to just load the illustration again. Just give me a second. I think I'll have to just load the illustration again. Let me just add the study material. Sometimes, you get technology as it's got on advantages, disadvantages at time. Just bear with me for a minute. I'll just load it back and we just get back to the illustration 56. Okay, so we were discussing the illustration number 56 with you. Right, so that is the step number 4, almost at the end of the step number 4. Right, so that was the illustration number 56, which I was discussing with you. Let me just zoom it further. I'll just quickly give you a synopsis of the discussion. Page number 3.83, illustration number 56. So page number 3.83, illustration number 56. Let me slightly zoom it further. Yes, I think that sounds good. Okay, so I hope it is clearly visible. Let me see if there is any questions coming in between. I think everything is going well. Okay. So in this particular case, we were reading that entity enters into a contract with the customer, and that is for 2 licenses, A and B, which the entity says is 2 performance obligations, and they're satisfied at a point in time. So I very clearly mentioned that it is a case of a CCM, a completed contract method. The standalone prices of A is 16 lakh and 20 lakh respectively, and the company transfers the license B at the inception, and it transfers A, that is 1 month later. Now, I was just looking at the case number A, where we decided that yes, we are going to consider that whatever is stated in the agreement is correct. So I was giving you the analysis of the step number 5 regarding the timing factor for the revenue recognition. So let me just put that once again and do the analysis with you. Now, in this particular case, what I made a mention is that we're looking at the case A. And in terms of case A, we said that there is a license A and there is a license B, and the fixed consideration relates to license A and the variable consideration relates to license B. So we made an evaluation and we said, yes, what the agreement states is perfect. So the fixed consideration in this case was 16 lakhs and the variable consideration is supposed to be 20 lakhs. Now I am looking at the entries from the revenue recognition point of view, that what are the entries which are going to be done. Now I am given, as far as the timing factor is concerned, A is going to be transferred 1 month later, and B is supposed to be transferred at inception. The control of the goods is going to be transferred at the inception. But I give you an insight that if you look at the appendix B of the standard, the appendix B is given us guidance, and it says that if your consideration is variable and there is a sales-based royalty, you cannot recognize a revenue when the control is transferred. The basic principle is the revenue recognition will always take place when the control of goods and services is given to the customer. But you can say, if you ask me indirectly, an exception. So I would say if a company has got a transaction price, which is a variable consideration, a sales-based royalty, the standard says that if it is a case of a sales-based royalty, the revenue recognition is going to take place at the later of the two dates. You need to consider the revenue recognition at the later of the two dates. Number one, when the control of the goods is transferred or the sales takes place, whichever is later. Whichever is later. So which means in this case, even though the question says that the control of the license B is transferred to the customer at the inception, I will not be able to recognize a revenue. Effectively, I will be able to recognize a revenue only when the sales occur. So I was trying to make a walkthrough in terms of the journal entries which a company would pass in terms of license A and B. Now watch this carefully. Now in this particular case, we can say in terms of A, there are two possibilities, that the fixed consideration is either received as an advance or there is no advance. The money is going to be received, let's say 1 month later only. So there are only two possibilities as far as a license A is concerned, that the customer pays you in advance. Now, if the customer pays me in advance today, I'm not in a position to recognize the revenue until 1 month when the control is getting transferred. So not an issue. If you get an advance, so what do? We put the entry bank account debit and you give a corresponding credit to the contract liability, or you can even call it as a deferred income account. Put this money collected as a deferred income or as a contract liability, since you cannot recognize a revenue. Now, 1 month later, what are you going to do? You're going to convert this contract liability and it will be translated in terms of revenue 1 month later. So this is the entry you pass today when the advance is collected, and this is the entry which you will pass 1 month later. So this is how the accounting entries would look like. I'll just make a walkthrough in terms of what is mentioned in the study as well. Now, if you say that there is no advance, of course, I cannot pass any entries today. I'm just going to pass the entry after the end of 1 month itself. So at that stage, once you receive the money, you give a debit to the bank or account receivable is created and a revenue recognition is going to occur at that particular point of time. Simple and straight. I hope I am pretty much clear on the accounting entries with reference to license A. I've taken two permutation combinations, that if you receive an advance, then what? And if you don't receive an advance, and then the simple entry is done at 1 month later. Now, coming to the license B. In any case, you cannot get any money in terms of license B, because unless the sales takes place, the customer is not going to pay you money. So no entries will be done at this stage. It is only when the sales are done, then you are going to put a similar kind of entry for the license B as well. Simple and straight. This was the revenue recognition in terms of case A. Let me see if any questions are coming to your mind so far. Okay, I think nothing is there, so I think let's take it further. Let me, just try to. Okay, I think nothing is coming so far. Okay, now let's go back to the question. And let's have a look at the inputs which is given in terms of case A. So I would just like to read the inputs which is given in the solution. So let's have a look at the inputs which is given in terms of case number A. Now, in terms of case number A, we are first of all given the analysis of the paragraph number 85. It says the entity transfers the license B at the inception of the contract, and it transfers the license A 1 month later. Upon the transfer of license B, the entity does not recognize a revenue. As I said, you have transferred the control of license B to the customer, but you cannot recognize a revenue because your consideration is variable. It is a sales-based royalty. You'll have to wait till the sales occur. So that's what it clearly says. The entity does not recognize a revenue because the consideration in this case is based on sales royalty. So I've already elaborated this picture to you. We're just reading it further to get a little more clarity on thoughts. So it says very clearly out here in this particular case, it will be allocated to license B in the form of a sales-based royalty. Therefore, the entity recognizes the revenue for the sales-based royalty when those sales occur. When those sales occur, that's what I gave you, that for the step number 5, your revenue recognition is going to occur only when the sale is made. When license A is transferred, the entity recognizes the revenue allocated to license A. So I've given you a little more extra analysis in terms of license A, because since the consideration is fixed, there are possibility that you get an advance. If you get an advance, it's treated as a contract liability and then translated to revenue later. But if it is not a case of advance, the revenue recognition will take place only a month later. Now, the case number B is going to be slightly complicated. I hope I'm pretty much clear till case A, because case B is going to be slightly more typical. So watch this carefully. Watch this analysis very carefully. I hope I'm pretty much clear till this stage. Okay, Koshki, you said, so I still have my previous question, and I think your previous question was, I guess I didn't get your question. I think maybe it's got stuck up somewhere. Can you put that question again? You said, sales, are we considering the sales of B of the total sales? No, we are considering the sales of B only, because in this particular case, if you're saying that the variable consideration relates to the sales of B, then whatever revenue is going to occur will occur on the sales of B itself. Yes. Okay, maybe I think your previous question is a control transfer at inception, how to determine when the sales took place. Okay. Well, as far as the sale is concerned, it's going to take place after 1 month. Because if you're going with the concept that sales is going to be computed on a monthly basis, so you can say that the revenue recognition in terms of license B is going to take place 1 month later, right? Okay, now I'm coming to the case number B. Now, watch this carefully. Let me first take you back on the case number B, because there are some changes in the facts. So let's have a look at the case B and watch my analysis very carefully, friends. Okay, now watch my analysis very carefully on the case number B, because this is going to be slightly technical in nature. So watch this very carefully for the next 5 minutes. The price stated in the contract A is fixed and B is variable. And we said we challenged the same, but here I'm just looking at license A is transferred 3 months later. And the royalty due from the customer, the first month's sale is 4 lakh. It says that the amount of royalty which you are getting at the end of first month is 4 lakh. Allocate the transaction price and determine the revenue recognition. Now, let's have a look at that. In this case, they've changed the facts. In case A, the license A was transferred 1 month later. But in case B, they very clearly mentioned that the transfer of the license is going to take place 3 months later. Now, let me make a walkthrough of the entries in terms of license A and B in case number B. Watch this very carefully. Okay, watch this very carefully as I take you to the case number B. This is going to be slightly technical, but just watch this carefully. So we're looking at the journal entries in terms of case number B. So this is license A and this is license B. The license A is going to be transferred 3 months later. The control of this is going to be transferred 3 months later, and B is transferred at the inception. This license is transferred at the inception, but as we said now, that the fixed consideration is relating to both A and B. 6 lakh is the fixed consideration relating to both A and B. 1. And there is a variable consideration that is 30 lakhs that is also relating to A and B. The variable consideration is also relating both to A and B. So this is the total transaction price, that is 36 lakhs. Now, please watch this very carefully. Please watch this very carefully as I give you the revenue recognition entry. Now, in this case, the fixed and the variable consideration is relating to A and B both. The transfer of control of A is 3 months later, and the transfer of control of B is at inception. Now, at the first thing, what I need to do in this particular case, let me first of all divide the 6 lakhs between A and B. Since the fixed and the variable consideration is relating to both A and B, you are going to divide the 6 lakh in the ratio of standalone prices. What is the ratio of standalone prices? A is 16 lakhs and B is 20 lakhs. So divide the 6 lakhs in this ratio. Divide the 6 lakh fixed consideration in the ratio of the standalone price. So if you divide 6 lakhs in the ratio of 16 is to 20. So if I divide this in this ratio, it comes to 2,66,667 for A, and it comes the remaining figure that is supposed to be 6 lakh minus 2,667, that's 3,33,333 for B. Okay, so what I've done at the first instance, I have done my step number 4. I have allocated the fixed consideration in the ratio of the standalone prices of A and B. Now let's see the entry. Let's see the entries at this stage. Let's consider that if this amount is received in advance, let's consider two situations. Let's consider two situations in terms of the fixed consideration. Let's say you receive the money in advance, and let's consider that there is no advance. Let's say that there is no advance. Let's see the entries in both the cases for license A and B. Watch this very carefully. Now, if the money is collected in advance, the customer gave you 6 lakhs in advance, out of which this amount relates to A. You cannot recognize revenue as far as A is concerned because the control is going to be transferred 3 months later. So what do? If you receive the advance, the entry done is bank account debit, and a contract liability is created to the extent of 2,66,667. Makes logical sense. In the study material, they've given all this explanation, but I'm giving you entries to understand the larger perspective. So in this case, if the customer paid this money in advance, you are going to put this money in the contract liability because A, revenue recognition cannot take place at this particular stage, right? Now, what do? This is the entry which you did today. And then later, after 3 months gets over, you're going to translate this contract liability and convert this in terms of revenue with the same figure that is 266,667. Makes sense? So this is as far as A is concerned. Now let's go to B. As far as B is concerned, the amount which you collected, this is a fixed consideration. This is not a variable consideration. So I don't need to apply the later of the two concepts. This money can be recognized as a revenue today itself because you've transferred the control to the customer. So in this particular case, you can easily put the entry bank account debit, and the revenue can be given a credit at this stage itself. That is 3,33,333. I don't need to wait for the sales to occur. I hope I'm pretty clear. So you can see that I've intentionally taken the concept of advance because I wanted to prove that in terms of A, you will not be able to recognize revenue at this stage. You need to wait till the end of the 3 months. The money is going to be parked in the contract liability and translated into revenue at the end of the 3 months. And in this particular case, the money is going to be converted immediately in terms of revenue. Let's look at the second combination, that when the advance is not collected. Well, if the advance is not collected, then in this particular case, what do? In this case, do you pass any entry today? No. You're going to wait till the end of the 3 months when you're going to put the entry bank account debit, and the revenue is going to be given a credit that is 2,66,667. So you're going to wait till the end of the 6 months when the money is collected, and at the end of 3 months, you're going to put this entry. What about B? If the advance is not collected, it doesn't make a difference. It doesn't make a difference in this case because revenue recognition is going to take place at the contract inception. So in this case, you're going to put the entry that is account receivable gets a debit and the revenue gets a credit to the extent of 3,33,333. The revenue will get recognized and you will recognize an account receivable at the stage. Later, at the end of the 3 months or whatever, when the money is collected. So once the money is collected, you can put the entry bank account debit, account receivable gets a credit with the same figure. I hope, friends, I am crystal clear on the concept. Let me consolidate the picture. Let me see if there is any questions coming to your mind so far. Okay, I think nothing so far today. I think the chat is going a bit slow, I guess. Weekend, Saturday, the chat is on a rest, I guess. Okay, anyway, the things were so technical as well that, the lecture went off in between, but no worries. I think we have still made up the things. So the moral of the story is, when you're looking at the case number B and you're saying that the fixed and the variable consideration relates to both the performance obligations A and B, we need to be very careful on the entries with respect to the step number 5. I've not started with step number 5, but I've just made a background in terms of step 5, because in this illustration in the study mat, we're also given the application of the step number 5. And in terms of the step number 5, you need to be careful on one part, that you cannot recognize a revenue until and unless the control is transferred. You cannot recognize a revenue unless and until a control is transferred. Right now, I'm concentrating on the fixed consideration. We'll talk about the variable consideration also. So in this case, if the customer pays the fixed amount of consideration to me right away as an advance, so in this particular case, the consideration is going to be, first of all, allocated in the ratio of the standalone prices of A and B, which is 16:20 lakh. Now, whatever money relates to A cannot be translated as revenue. So you're going to park this as a contract liability at the inception. So you're going to put the entry bank to contract liability, and this contract liability translates into revenue only at the end of 3 months when the control is transferred. But as far as B is concerned, since the control is transferred at the inception, you will put this entire money as revenue. That is one case. Second, if the advance is not collected, no worry. For A, the revenue recognition and the collections will be 3 months later. And as far as B is concerned, revenue recognition will be today because you transfer the control. So we're going to recognize an account receivable, a debtors, and revenue, and then you can collect the money later. This is the fixed consideration. Now let's have a look in terms of the variable consideration as well. So we're looking at A and we're looking at license B, and now I'm looking at the variable consideration. And we have said that the variable consideration, which is to the extent of 30 lakh, also relates to both A and B. But this 30 lakhs is going to be collected over a period of time. So the sales are going to be made on a monthly basis, and he gives you that the sales of the first month. The question gives you that the sales of the first month is supposed to be 4 lakh rupees. So I'm not concerned with the entire 30 lakhs. I'm not concerned with the entire 30 lakhs. I'm concerned with the sales for the first month, because you're going to recognize now the revenue. Mind it. Since the revenue is variable in nature and is royalty based, you cannot recognize the revenue based on the date when the control is transferred. You need to recognize the revenue now on the basis of later of the 2 dates, when the sale is made or when the control is transferred, whichever is later, which means effectively now the revenue recognition is going to take place at the time the sale is made. Now watch this carefully. I'm now looking at the journal entries in terms of license AB. This is first month end. This is first month end. This is second month end. And this is third month end. Now watch this carefully. I am given in the question the sales only for the first month end. I'm given the sales only for the first month end. Now, Remember, you are recognizing the revenue at the later of the two dates. What is the later of the two dates? When the sales is made or when the control is transferred, whichever is later. Let me ask you a question if your chat is working. A, the control is transferred 3 months later, the sales is made 1 month later. Can you recognize revenue 1 month later? The question is simple. You can recognize the revenue at the later of the two dates when the sale is made or when the control is transferred. The control for A is getting transferred at the end of 3 months. So even if the sale is made at the end of the first month, would you be able to recognize revenue in terms of A? Let's see if you're getting some answers on that. Okay, I think Namrata said, can you please summarize case A as well? I'll do that. I'll do that. Once I'm done with case B, I'll summarize the entire inputs to you, which is a beautiful part of this question. And Koshi, from where do you get the conclusion that A and B both have fixed and variable consideration? Is it mentioned in the question? We just did that before the break, where I said that, the agreement says that 6 lakh relates to A and 30 lakh relates to B, but it is inconsistent with the standalone prices. The same question we're doing. So we decided in case number B, we don't accept the agreement, and we concluded that the variable and the fixed consideration relates both to A and B. Right? And that's rightly given, Janvi. That's right, Namrata. Absolutely correct. So which means in terms of A, when the sale is made and you get the money collected, it's still going to be parked in the contract liability account. It's still going to be parked in the contract liability account. This 4 lakh rupees will be allocated in the ratio of the standalone price. That is 16 lakhs and 20 lakhs. Whatever is the amount of sales which you have calculated in this particular case, you're going to allocate this in the standalone price. Let's see. So 4 lakhs allocated in this ratio, that works out at almost 1,77,778. Will I be able to recognize the revenue in terms of license B? Yes. Inception or sales, whichever is later. So in this case, the entry is going to be bank account debit, and contract liability gets a credit. And this is the remaining figure, 4 lakh minus 1,778. This comes to 2,22,222. Wow. Am I going to do similar entries in the second month as well? Yes, depending upon the sales figure. Am I going to do the similar entries at the third month? No. At the end of third month, the entry in this case is going to be bank account debit, and now you can give a revenue a credit. And all the amount in the contract liability at this stage will get translated in terms of revenue. In terms of license A, you're going to put this entry for the third month sale, and whatever is the sales of the first and the second months, the contract liability gets translated into revenue at this stage. In this case, the entry continues to be the same. So this is highly technical in nature. This is too technical in nature. Can you please consolidate the entire inputs in terms of things? Let's do that. Because as I said, this is one of the beautiful illustrations in the study mat, which throws a very good understanding in terms of the revenue recognition entry in step 5. So before we go to the step number 5, let me spend some time and let me consolidate this input stream. So let me just summarize this input. So let me now make some notes at this particular stage. So watch me carefully, friends out there. Okay, so watch this carefully. Let me consolidate the journey and let me see if there are any questions coming in between. Okay, no, not as of now. Let's, I think, take this forward. Now, watch this carefully. The next 5-10 minutes is going to be very crucial indeed. Now, we need to understand in this particular case, this is the illustration number 56. I'm going to look at the different permutation combinations and watch this very carefully on a consolidated manner. I am given two cases in this question, case A, and I am given a case number B. Now let's first of all look at what is the inputs in terms of case A. In terms of case A, we accepted that the agreement says the fixed consideration relates to A, the variable consideration relates to B, and we said, yes, it seems to be logical. The agreement is not a manipulation. I gave you two steps. You first of all note down what the agreement states, and then you see what is the standalone price. There was no inconsistency between what the agreement states and what is the standalone price. So therefore, we concluded that as far as license A is concerned, the fixed consideration relates to license A. So we decided that the fixed consideration relates to license A, and we said that the variable consideration relates to license B. As is stated in the contract, it was accepted. This is one input. Another thing which was given as a part of the question was that the control of the license A is transferred 1 month later, and the control of license B is transferred at the inception. This is the case A. Now let's look at the case B. In terms of the case number B, we decided that as far as the consideration is concerned, we said we don't accept the agreement. We said we don't accept the agreement. The agreement says the fixed relates to A, 6 lakh, and variable 30 lakh relates to B. But we said standalone prices 16 and 20. Inconsistency. So the agreement breakup and the standalone prices are in disagreement. Therefore, we said we don't accept the agreement, and we said in this particular case, the variable and the fixed consideration is to be allocated to both A and B. We don't accept the agreement, and we are saying that both variable and fixed consideration relates to A and B. And then we also added on that as far as the transfer of control is concerned, they made a slight little change, and they said that the control is transferred 3 months, and in terms of B, it is transferred at inception. So unlike case A, where the control is transferred 1 month later, in terms of case B, it is transferred 3 months later. I hope I'm very clear till this stage. This is what we're looking at, the step number 4. So this was step 4, that what is the allocation of the consideration? This is the allocation of the consideration. Now we're focusing on the step number 5. Though we yet to start with the step number 5, but we're focusing on the step number 5. Now let's have a look at the step number 5. Now, in terms of step number 5, we said, okay, let's begin the entry. So we know that the fixed consideration was to the extent of 16 lakhs in this case, and the variable consideration was 20 lakhs in this case. Here, the fixed consideration was supposed to be 6 lakhs, and the variable consideration was 30 lakhs. So that was the breakup of the fixed and variable consideration. Now, we said, okay, let's go one by one. So you've got license A, you've got license A, and you've got license B. You've got license A, and you've got license B. Now let's go one by one. So we said that there is a fixed consideration, it relates to A. I said, okay, fixed consideration relates to A. You will not recognize the revenue before 1 month. The fixed consideration relates to A. I said, don't recognize the revenue before the end of first month. So what if I receive the money right now? I said, okay, not an issue. So you're saying, did you receive an advance? You said, yes, I received an advance. So this is the fixed consideration which you received in advance. I said, not an issue. You put the entry bank debit, and whatever money you received is going to be parked. That is 4 lakh rupees. Sorry, the fixed consideration received was how much? 16 lakh rupees. Okay, so in this particular case, we said that the entire 16 lakhs which you received is going to be taken as a contract liability. The money received, put it in a separate account, forget it till the end of the first month. Then I said, okay, after 1 month later, do one thing, translate this contract liability and translate this in terms of revenue. And this 16 lakhs gets translated in terms of revenue, which is 1 month later. Simple. The money collected today parked in a separate account and then translated into revenue 1 month later, because revenue cannot take place until the end of the first month. I hope I am absolutely clear. Okay, now This is a situation when you said that there is an advance. This is a situation when you said it's an advance. I said there is no advance. I did not receive any advance. I said, okay, if you did not receive any advance, then wait for the 1 month. Wait for the 1 month. When you get this money, you put the entry bank debit and you give a revenue, a credit at that stage when you collect the money. Thank you. So I think license A in case A should not be an issue. You get the money, put it in the liability account, trust it into revenue later. If you get the money 1 month later, just put that money as a revenue at that date. Done. This is license A. Now let's come to the license B. Now, in terms of license B, this 20 lakhs is not going to be collected on day one. It's not going to be collected after the end of first month. Since it is based on the annual sales, you will get the money every month end. You're going to get the money every 1 month end. I have transferred the control at the inception, but the standard says you can't recognize the revenue at inception, because if the consideration is variable and it is a sales-based royalty, it's a sales-based royalty, the standard says you cannot recognize revenue at the time of control transfer. You need to consider the control or the sales made, whichever is later. So which means that I have to wait in this case. This means I have to wait in this particular case. I'm going to wait, and every month end, in this case, every month end, what will I do? Once the sale is made, the royalty is given to me, I'm going to put the entry bank account debit. Revenue will be given a credit. So depending upon the royalty which you receive at the end of each month, I think he gave you the figure of sales. I think it was 4 lakh or something. So whatever is the royalty you receive, you put the entry in this case. So this will continue at the end of every month. This will continue at the end of each month. Right? I hope I'm very clear with case A. I hope, friends, I'm very clear with case A. Okay, I think we got a question, Shriram. So in case A and B, instead of recognizing contract liability at the end of each month, and transferring the contract liability to revenue at the end of the third month, why shall we not directly recognize the entire amount as revenue at the end of third month? You're getting money, where do you park it? The question is, if you're getting money, where do you park it? You put the entry bank account debit, you need to give some corresponding credit in the books of accounts because you're collecting money. So the collection of money is like an advance collected from the customer, which you owe back to the customer, because unless you recover, pass the control to the customer, you can't make use of that money. So it's going to be parked in a separate account, which is called a contract liability or a deferred revenue in this case, right? So I hope this part is pretty much clear. When the consideration fixed relates to A and the variable relates to B. So in case of B, we are saying, let's wait month end by month end and recognize revenue. Is that absolutely clear, friends? A message on your part would, I think, give me that we are very clear with the inputs. So are we pretty much clear with this particular part? Now let's go to the complications. Namrata, sir, this example is a little bit exhaustive. Yes, it is. It's a wonderful example, as I said. I think one of the best examples in the study material on the application of step 5, especially the variable and the fixed consideration. Beautiful. Okay, now let's go on to this particular part, and I am again considering that there are 2 licenses, A and B. So we're looking at the license A and we're looking at the license B. Now watch me carefully at this particular stage. Okay, that's clear. Wonderful indeed. Now, in this case, the variable and the fixed consideration relates both to A and B. I now need to be careful. Fixed consideration, the later of the two doesn't apply. When you're looking at a fixed consideration, you can recognize the revenue on control transfer. It is only for the variable consideration you need to apply the later of the two. Okay, so let's do one thing. Let's talk about the case of the fixed consideration separately, and let's talk about the variable consideration separately, because when it comes to a variable consideration, you need to consider the later of the two. So for the fixed consideration, we go to consider what? Control transfer. For the variable consideration, you go to consider what? Later of the two, control transfer or the sales made. Okay, let's begin. So before we pass the entries, let's get this clear. In case of fixed, you need to see when the control was transferred. The control is transferred 3 months later. When was the control transferred in terms of B? At the very inception. So you can recognize the revenue 3 months later, you can recognize the revenue at inception. But in terms of the variable consideration, when do you consider the control transferred? You need to consider 3 months or the date of sale, whichever is later. In this case, you need to transfer the control revenue recognition when? You can say at inception or when the sales is made, whichever is later. Are you getting the point? You need to be very, very conceptually sound on that issue. For the variable consideration, the revenue is 3 months or sales, whichever is later. For B, inception or sales, whichever is later. Okay, now see the interesting part. When it comes to the fixed consideration, we divided this 6 lakh rupees in the ratio of, we divided the 6 lakh rupees in the ratio of stand-alone price, that is 16:20. We divided the fixed consideration in the ratio of 16:20. Now, if you get the advance, there are two cases now. Are you getting an advance or you are not getting an advance? That's the two possibilities. That either you're getting an advance or not an advance. I said, yes, I collected an advance. If I collected an advance, bank account debit. Bank account debit. What do I credit? Not before 3 months. So got to put this amount in the contract liability credit. Later, at the end of 3 months, the contract liability gets translated in terms of revenue. I think the picture is clear. Absolutely similar. Absolutely similar, that if you collect the money, you put it in the contract liability, wait till the end of the 3 months. In case of B, you get the money right now. You get the money right now. Since you can take revenue at inception, put it in the revenue right away. So very interesting combination. In terms of A, you need to wait till the end of 3 months. So you parked it in the contract liability. In terms of B, you can take the revenue at inception. You put that in the revenue right away. I hope I am very clear. Now let's consider that if there is no advance. If there is no advance, then you will put this entry bank to revenue at 3 months later. This entry is going to be recorded at 3 months later. Once the 3 months pass by, you put the entry bank to revenue at this stage. In this case, you need to put this entry, the same entry, can I say as of today itself, at the inception itself. So even if you don't receive the money, put the account receivable. If you don't get the money right away, put the account receivable, but revenue recognition has to be done today only. Right? Okay, now let's come to the variable consideration part. Now, the variable amount will be received slowly and steadily, month by month. So once the first month gets over, you get some money. Once the second month gets over, you get some money. Once the third month gets over, you get some money. You keep getting money month by month. In this case, 3 months or sales, whichever is later. So when you receive the money, you cannot recognize revenue. You park it in the contract liability. Even second month you receive the money, you put it in the contract liability. It is only from the third month onwards, you will start recognizing a revenue. Whatever amount is there in the contract liability can be translated to revenue at the end of third month. In terms of the money related to license B, you are recognizing sale or inception, whichever is later. So bank will be given a debit and the revenue can be given a credit. Same entry for second month, same entry for third month. I guess the logic is pretty much clear. You just need to revise things and I think you'll get things absolutely wonderful clear. But I think I've created all the permutation combinations. And my idea was basically to expose you step 5. I've been basically working on step 5 indirectly with you. So I hope I am absolutely clear on the agenda. So the main issue is the revenue recognition timing factor. And that depends upon if the consideration is fixed. What do you consider? The control transfer date. When you're considering a variable consideration, typically sales-based royalty, what do you consider? The control transfer or the sales made, whichever is later. Right, friends, I hope I am absolutely clear with the agenda, right? So I guess pretty much clear on this. Any questions coming to your mind, you can ask me. Now, I think I am ready to go to the step number 5, the last step of this particular Ind AS. Let's, I think, take this further. No worries, these notes will, of course, be shared with you. So I am now going to come to the step number 5 in the standard, which is on the revenue recognition, the timing factors. So let's give you now insights on that. Okay, so let me just add and give you a thought process now on the step number 5. I know it's a very comprehensive standard indeed, and it's a wonderful standard indeed, but as I said earlier as well, you need to give it a consolidated revision. I would say, since you've got a weekend before the next class on Monday, do one thing, sit down and make a consolidated revision of this particular standard. So once you sit down and revise all the steps, the connectivity is going to be superb. Do the illustrations of the study mat and the test your knowledge questions. The questions given on Ind AS 115 in the study mat is quite exhaustive indeed, and you're going to get a good practice out of that area. Now, let me come back to the last step in this model, and that is step number 5. This is on revenue recognition. Now, let me explain something at this stage. Let me give you the chain of thought at this stage. The main focus is the para number 35. Now, when you're looking at the revenue recognition, the main thing to be done in this case is you need to decide the timing factor. You need to decide the timing factor when to recognize revenue, which we've just had a flavor in terms of the previous illustration. Now, there are two aspects in terms of step number 5. I repeat, there are two aspects in terms of step number 5. One is, the first aspect is that you need to first of all apply a control test. You need to apply first of all a control test and ask yourself a question: have I transferred the control of goods and services to the customer or not? If you look at the earlier standards in terms of IGAP, the focus has always been in terms of a risk and reward test. You'll see in terms of Ind AS, in many standards, the concept of control test has been inserted. Like, for example, when you go to study the standard on leases, we're going to consider that a contract is going to be considered as lease when you can prove that you transfer the control to the other party. When you go to consider the concept of financial instruments and other standards, you're going to see that everywhere in Ind AS, they've done away with the erstwhile test called a risk and reward test, and they've entered into a control test. Now, from the examination point of view, it's going to be very difficult to make an assessment of a control test, but at least theoretically, I can tell you that what control test is. One thing is very clear, that control test is much wider. It is much wider than risk and reward test. It is much wider as compared to the risk and reward test. Now, let me explain you certain parameters which decides a control test. If you look at the standard Ind AS 115, it very clearly brings out that when you apply a control test, there are a couple of parameters to be evaluated. There are a couple of parameters to be evaluated to decide whether the control is being transferred to the customer or not. One of the parameters is that have you transferred the physical possession of the goods to the customer or not? So one of the parameters is to see that have you transferred the physical possession of the goods to the customer or not. The second parameter is that in this case, has the customer accepted the goods or not? Has he accepted the goods and services or not? That's number 2. Another kind of parameter which you need to evaluate in this case is that in this particular case, is the entity entitled to receive consideration? Is the entity entitled to receive a consideration? So you need to see that, are you entitled to receive a consideration? He's accepted the goods, you've given him a physical possession, and you are entitled to receive a payment or not. Then you also need to look at the risk and reward as well. So risk and reward is just one element of the control test. So as I said, that from an examination point of view, it's going to be very subjective input. So you don't get questions in terms of deciding whether the control is being transferred or not. You will be very clearly given that the control is transferred or not. So this is one aspect in terms of revenue recognition, that you first apply a control test and decide that, okay, have I transferred the control to the consumer, customer or not? Once you say yes, then the second aspect arises. Once you decide, yes, the control has been transferred, then the next step arises that we're going to decide the timing factor. We're going to decide the timing factor, that do we recognize the revenue on a percentage of completion method, or do we recognize the revenue on a completed contract method? So we need to take a decision that, am I going to consider a revenue on the basis of percentage completion, or are we going to consider on a completed contract method? This is called, if you look at the language, it says as and when. And this is called at a point in time. This is called at a point in time. So this is called at a point in time. At a point in time. As we saw the language in one of the questions, that once the performance obligation is completed, so we are saying that we're going to recognize the revenue at a given point in time, let the performance obligation get completed. And in this case, it says as and when. So as you're doing the work, let's recognize the revenue. Now, on this concept of timing factor, the main guidance is given in terms of para number 35. You don't need to remember the para, but I'm just giving you for your understanding that there is an insight which is given in terms of para number 35, which tells me a very conclusive area that, okay, if this condition is met, you apply a PUCM. If this condition is met, then you apply a CCM. So I'm now going to take you to the extract of the para number 35, and we're going to get a flavor in terms of how do we decide the revenue recognition. I'll give you a couple of examples which are given in the study material as illustrations during the course of discussion itself. Okay, so let me just take you to the para number 35. So I've taken an extract of the para number 35, and let's have a look at this. Just a second, let me just load it through. Yes, this is my para number 35, and a small little para, but I think a very interesting one indeed. So we're going to make some good analysis out of this discussion. Okay, I think it should be visibly clear enough indeed. We can maybe zoom it a little further as well. Okay, now hear me very well on this. This is a very interesting input as well. I'll give you a couple of examples as we understand this particular para number as well. So this is now giving us inputs in terms of the timing factor. Now please hear me very carefully. So it says, an entity transfers the control of goods or services over time. It says an entity transfers the goods or services over time, and therefore satisfies a performance obligation and recognizes revenue over time if one of the following criteria is met. There are three conditions, three parameters given in para 35. You meet any one of them, you apply a PUCM. I repeat, you meet any one of them, you apply a PUCM. You fail all three, you apply a CCM. Get this very clear. That in this particular case, if you meet anyone, meet anyone, you apply a percentage of completion method. And the second one is you fail all. You fail all, then you apply a completed contract method. So one thing is very clear, that what you need to do, you need to go in a chronological order of things. You will consider this as a three-step model. Wow. So my step number 5, I have created a three-step model based on these three parameters. So we're going to go to step number A, and if the step number A is passes, you apply percentage of completion method. And if it fails, you go to the step number B. Then you go to the step number B, and here again, if this step passes, then you apply a percentage of completion method. And if it fails, then you go to the step number C. Wow. And then you go to the step number C, and here again, if this passes, then you apply a percentage of completion method. And if this fails, then in that case, a completed contract method. It's a three-step model. It's a pretty simple three-step model. You're going to apply step A. If you pass, percentage completion. Fail, go to B. You pass B, percentage completion. You fail, go to C. And in C, you pass, it is percentage completion. You fail, then it is automatically completed contract method. Now let's see what are the three steps in this case. The customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. I need to prove that as the entity performs the performance obligation, the customer is receiving and consuming the benefits. It's a simultaneous receipt and consumption and performance by the entity. So the word is very clear. You need to see that there is a simultaneous. You need to see that there is a simultaneous concept. That means as the entity performs, the customer is getting a benefit there and then. How would I evaluate this? Let's take some examples to understand this. If I say that when the entity is performing an obligation and the customer is simultaneously receiving a benefit, you're going to put across a simple question to yourself. This is for understanding. You need to put across a simple question to yourself. Let's say there is an entity A which is performing an obligation for a customer. Let's imagine if this entity A is said, you leave, I'm going to appoint another entity to do the job. I'm going to put across a question. Let's say entity A is doing a job for the customer. I'll say, okay, let's think that this entity A is out of the picture and let's appoint another entity B to do the job. Is this entity B going to do the entire job all over again? Or is he going to start from the trail where the earlier person left? If you say that he has to do the entire work all over again, he has to re-perform the entire work all over again, then in this particular case, simultaneous benefit is not coming. But if you say that he starts from the point where A entity left, then simultaneous benefit is coming. Let's take an example to understand this concept. Let's say, for example, entity A is providing, let's say, payroll accounting to a client. Entity A is providing, let's say, payroll services to the client. It goes to the customer's place every month, does a payroll services to the client. Now, let's say for any reason, if I tell A entity, boss, your service is no longer required, I'm going to appoint another entity B. Do you think entity B is going to do all the work which entity A did in the past? Or is he going to continue the trail from where the entity A left the job? The entity B is certainly going to continue the work from the where A left the trail. So in this particular case, I can say that the customer is getting a simultaneous benefit. As the entity was performing the obligation, the customer was getting a simultaneous benefit in this case because the new company appointed is not going to redo the entire work. So in terms of the step number A, when you look at a simultaneous concept, you need to put across a question that do we need to re-perform the work or not? That if a new entity is appointed in its place, do we need to re-perform the work or not? So if you say no, there will be no re-performance, the condition A is met. But if you say yes, the re-performance will be done, you'll have to do the entire work, then in this particular case, the condition A fails. Let's give you another example to understand this bit as well. Let's say, for example, A Limited is appointed as an auditor to company B. Let's say he's been appointed as an auditor to do, let's say, a statutory audit for a client. Now, in this particular case, let's say for any reasons, the company A is told to go and another company is appointed to do the audit. Do you think this company B is going to pick up the trail from where A left? Or is he going to re-perform the entire auditing techniques? Of course, he's going to do the entire techniques all over again. He's not going to continue the trail from where the other person left. So which means in this case, simultaneous benefit is not coming to the customer. So it all depends upon the nature of services. It all depends upon the nature of services. Like, for example, if you say that a customer is getting, let's say, washing services from a particular entity. An entity is providing services of cleaning clothes every month. So in this particular case, what is happening that anytime a new entity is appointed, he's not going to clean all the clothes back. He's going to continue the trail from where the earlier company left. So in most of the services, why am I using the word services? Because clause A will typically apply to the concept of services only. That if an entity is providing the services to the client and you can prove the fact to me that if another company comes in its place and it will pick up the trail from where I leave, the customer is getting a simultaneous benefit. But if the new entity is going to start the work all over again, then in that particular case, simultaneous benefit is not coming. That's one. Next. The second clause, it says the entity performance creates or enhances an asset. It says, for example, a WIP that the customer controls as the asset is created or enhanced. If you ask me, typically, I would say the clause number B is very well applicable in a real estate sector. So for example, let's say a customer, gives you a piece of land. So when he gives you a piece of land and then he says, okay, you construct me a building on this piece of land. So when he says that you construct a building on the piece of land, even if the building is incomplete and it is in a semi-finished stage, it is in a WIP stage, the entity, the customer still gets a control over that, because the land ultimately belongs to the customer. So in this particular case, even if the building is incomplete, the control of the asset is always with the customer. So when it says that the entity performance is going to create or enhance an asset, so you're talking of a building construction. For example, it is in a WIP stage. The customer controls as the asset is getting created. But let me tell you that if, let's say, for example, as a customer, you are getting, let's say, a machinery built from a company. Now, this machinery is going to be built in-house at the company's place. So in those particular cases, it will be difficult to prove the satisfaction of clause B. You can prove in case of a building being constructed on a piece of land owned by the customer that when the construction is still in progress, the customer controls the asset. So even in a WIP stage, the customer controls the asset. But it would be difficult to prove in terms of movable assets construction, like, for example, a machinery, that once the machinery is being constructed, it will be difficult to prove that the customer gets a control. Generally, in those cases, the customer will not achieve a control until and unless the entire asset is complete. So the clause B focuses on that the customer, is he getting a control? Is he getting a control on WIP? We need to see that is he getting a control when the product, when the goods and services is in a semi-finished stage. So if you can say that if the things are in progress and the customer still gets a control over in progress items, then a percentage completion would apply. Now let's have a look at another case. It says entity performance does not create an asset with an alternative use. I would put it like this, that the clause C is focusing on a tailor-made services being done to a customer. I am producing goods, I am providing services for which I don't have an alternative use. I cannot use the work which I've done for my another client. So it says the entity's performance does not create an asset with an alternative use to the entity. So it's a tailor-made work done for a particular client. I cannot use my efforts for another client. I've got no alternative use for the work done. And then it says, and there is a subclause, and the entity has an enforceable right to payment for the work completed till date. So there are two subconditions in the third clause. There are two subconditions in the third clause. So we can say, number one, the entity has got no alternative use of the work done. So whatever work I've done for the client, I've got no alternative use for that particular work. And secondly, I should be entitled to payment. I should be entitled to payment. And this entitlement of payment is not only with respect to the cost incurred. The standard clarifies that the entitlement to payment should include a reasonable profit margin as well. I should be able to recover the cost which I've incurred for the customer, and I should also be able to get a reimbursement of a reasonable profit margin as well. So let's, I think, consolidate the picture. So what do you need to do in terms of step number 5 to decide the method for recognition of revenue? You need to first of all put across the question, is the customer getting a simultaneous benefit as and when the entity performs an obligation? So if you say that if a new entity is appointed in place of the old one, does it need to redo the entire work? No, simultaneous benefit is coming. Does it need to redo the entire work? Yes, simultaneous benefit is not coming. Then go to step 2. In the step number 2, the focus is that when the work is in a semi-finished stage, it is in a WIP stage. Can you prove that the control of the WIP is with the customer? Generally, in a real estate sector, when you're looking at a building construction, you can easily say that the semi-finished goods is definitely within the control of the customer. If yes, it's a percentage completion. If no, you go to the step number C. In step number C, you need to look at the 2 conditions. The condition number 1. The condition number 1, you need to see that the entity, whatever work they've done for the customer, they don't have any alternative use. Because it was a tailor-made work which was done for the client, and I don't have any alternative use of that work for some other client. But at the same time, I should be able to recover the cost incurred along with a reasonable profit margin. If yes, it's a percentage completion, and if no, it's a completed contract method. I think let's do a little practical illustrations with you, friend, at this stage, and then we get over the standard. Then I'm going to give you a lot of things to read additional as well. So let's, I think, take you on a small little question out here. Okay, I think I need to take you to the study material for this. There is one or two simple questions which are given in the study material on step number 5. Let's take a jump and take you to the study mat. This is still far. We need to go to almost illustration 60, I guess. Okay, so I think here we are. We can just have a look at a simple little question. Let's have a page number 3.90. So there is an illustration on page number 3.90. So we're just going to have a look at this illustration. I've already discussed the facts with you, but I think we can still have a look at this illustration. Okay. So, as I said earlier, also, there is a lot of inputs which are given in the standard. There are some additional clarification points as well. So you'll have to go through the illustrations in one go in the study material, because the overall basic framework I've given, I wish I had a little more time. I would have digged into more appendix issues also with you, because it's a pretty long standard. And of course, if you want to get into more details, you need a little larger time at times. But I think we've justified the standard to the extent of an extensive discussion on the 5-step model. Okay, let's have a look at the illustration number 59 of the study material that is on in the study material. Okay, I think the page number I just missed. It says Minitech is a payroll processing company, and Minitech enters into a contract to provide monthly payroll services. They're providing monthly payroll processing services for a period of 1 year. How should the entity recognize the revenue? Well, I need to see in this particular case that when the reporting entity is providing payroll services to the client, is he getting a simultaneous benefit out of this? Let's assume that they appoint somebody else to do the work. Is he going to continue the work from the place where he left? Or is he going to continue? Is he going to redo the entire work? Well, I don't think so. The entire work needs to be redone, because the services are in the nature of payroll services. So it says that payroll services is a single performance obligation. And then it says customer simultaneously receives and consumes the benefits of the entity's performance obligation. So in this particular case, a percentage completion method would make complete sense. Right, so I think now let's take you to another interesting example, illustration number 60, which can be sometimes a point of confusion, especially when you're looking at a simultaneous advantage in this case. So let's have a look. This is illustration number 60, where we're again looking at the application of the clause A. It says T&L Limited is a logistic company that provides inland and sea transportation services. The customer, it says, enters into a contract with T&L for a transportation of goods from India to Sri Lanka through sea. The voyage is expected to take 20 days from Mumbai to Colombo, and T&L is responsible for the goods from Mumbai to Colombo. So whether the performance obligation is met over a period of time or not. Now let's imagine in this case, you are moving the goods from station A to station B, and in between is station C. The ship travels from station A to station C, and now I'm saying, is the customer getting a simultaneous benefit? Let's assume you engage somebody else from station C. Do you think he's going to go back and conduct the entire voyage all over again? Of course not. He's going to carry on the journey and the voyage from the point the goods are left. So which means, is there a need to redo the entire work? No. So even if the company is in the business of providing a voyage, and I know that I need to make the goods reach a particular station, but once I reach a particular station and if somebody else is appointed, I don't need to redo the entire work. So in this particular case, we can definitely say that the simultaneous benefit is being consumed by the customer, and if simultaneous benefit is being consumed by the customer, we can say a percentage completion can easily apply. Okay, so therefore it says it can be recognized over a period of time. Let's take one more question with you. So let's consider one small little further question with you, which could be in terms of, okay, let's, I think, look at the illustration number 61. Let's have a look at illustration number 61, the last question of the day. And let's see, in this particular case, are we meeting the concept of a percentage completion method or not? Okay, let's have a look. It says AFS is a risk advisory firm and enters into a contract with the company WBC to provide audit services that results in AFS issuing an audit opinion to the company. Okay, so they are basically providing services of giving an audit opinion. It says the professional opinion relates to the facts and circumstances that is specific to the company. Wow. So it's something which is a tailor-made job which you're doing for the client. If the company was to terminate the consulting contract for reasons other than the entity's failure to perform the promise, the contract requires the company to compensate the risk advisory firm for the cost it has incurred plus a 15% margin. And this 15% margin seems to be quite reasonable on similar kind of contracts, whether we should consider the performance obligation over a period of time or not. I think in this particular case, what is coming to the mind is the third condition, which says that if you are providing any kind of goods or services to a customer for which the entity has got no alternative use, I am providing an opinion to the client, and this opinion cannot have an alternative use to me. I can't use this opinion for another client. But at the same time, I should be getting a compensation for the cost incurred, including a reasonable profit margin as well. So I think the third condition, the two parameters are getting met. Number one, that you are doing a work for the client which is got no alternative use to you. Number two, you're getting a reimbursement of the cost along with a reasonable profit margin. So I think in this case, a percentage completion method can be applied. So yes, the revenue recognition can certainly take place over a period of time. Right, friends, so that was on the step number 5. So that finishes the standard, but not exactly the entire standard. As I said now, there is a little inputs which is required at your end. I've also added in my examples with you a few illustrations on certain areas of Appendix B. Because if you notice in this entire 5-step model in the standard, there are a couple of clarifications related to certain steps, which we've discussed a few of them, but not all of them, considering the time constraint as well. But I think you'll be able to easily get the grasp of those clarification issues. Like, for example, you'll see a clarification with regard to goods sent on consignment. Like, for example, you're going to see some clarifications with reference to the goods which are, held for sale. It's like a bill and a hold arrangement. But these are not technical issues. These are only clarifications with regard to the larger five-step model. But I'm happy that at least you have covered the entire five-step model in a good detail. So what you need to do now, you need to make a complete thorough revision of this particular standard. And as you make a revision, please go through the illustrations of the study material along with these small clarifications which are given. So once you're able to complete the study material illustrations along with your test your knowledge questions, trust me, you're going to feel very much confident indeed. First, make a complete revision of whatever we have covered in these 5 classes, and then go through the study material illustrations and test your knowledge. If you've got any questions, please mail them at the respective mail for the final queries. I'll be more than happy to solve your queries as well. My journey doesn't end out here with you. Of course, we're going to be attached with you for any further queries and all. Monday, I would be joining you for another standard on Monday and Tuesday. Then I think some of the faculty will be coming in for some more sessions with you. Monday, we're going to meet and we're going to start with the standard on Ind AS 24, which is on a related party disclosure. Tuesday, we've got a standard which is Ind AS 108. So I think it's going to be a little easier standard after such a heavy standard. Indeed, it's going to be a little relief, in between with the disclosure standards coming in. Let me see if you've got any questions at this stage, friends. Then I think let's take your questions. Otherwise, I think we're going to call it this day. Any question, friends, coming at your end, please feel free to ask. Otherwise, I think we're done for the day. So we're going to see you on Monday in that case. Okay, I think so far so good, it seems. Okay, and yes, I think we got Nidhi. Thank you so much, sir, for the amazing lectures. It was great to learn the standard in depth. Thank you, Nidhi. That makes really makes a good day for me. Thank you very much indeed. Much appreciated for your things. So thank you, friends. So we're going to join you back on Monday. Thank you. Bye-bye and take care.